Labrīt! Esiet sveicināti Latvijas Bankas ikgadējā konferencē, kas šogad ir veltīta finanšu tirgus attīstības tematikai un kuru mēs organizējam kopā ar mūsu lieliskajiem partneriem SUERF, Eiropas naudas un finanšu fórumu. Mans vārds ir Andris Strasts, es būšu, kā jau tas ierasts, konferences vadītājs. Arī, kā jau tas ierasts, mēs pulcējamies šeit Latvijas Nacionālās bibliotēkas Ziedoņa zālē, un paralēli arī konferenci ir iespējams vērot tiešraidē. Ziedonim, kā zināms, ķeburkājs bija ar ķ. Latvijas Bankas konference nav ar k, bet ir ar c. Un iemesls ir nevis tas, ka Latvijas Bankas konference būtu lēnām sākus pārcukuroties, bet gan tas, ka šis ir starptautisks pasākums un mūsu pamata norises valoda ir angļu valoda. Un līdz ar to, ja jūs vēlaties par konferenci kaut ko čiepstēt platformā X vai ziņot kādos citos sociālajos tīklos, tad ir lūgums lietot anglisko tēmturi LB konference, jeb latviski LB konference. Un tad, protams, aktīvi diskutēt, aktīvi piekrist, nepiekrist un tam līdzīgi. Un ja jums gadījumā angļu valoda nav tā, ka jūs tajā jūtaties kā zivs ūdenī, tad ir iespēja klausīties konferences latviski mūsu lielisko tulku izpildījumā, kas vēl nav paņēmis austiņas, var zāles aizmugurē to izdarīt. Un tad tālāk es arī runāšu angļu mēlē. So, ladies and gentlemen, welcome once more to the annual conference of the Bank of Latvia, which we are this year organizing together with our partner SUERF, European Money and Finance Forum. And without much further ado, I would like to invite the Governor of the Bank of Latvia, Mārtiņš Kazāks, for his opening remarks. Governor, please.
Labdien! Prieks jūs redzēt. Ar redzēšanu diezgan pagrūti, jo spīd acīs. Ja, bet var redzēt, ka zāle pilna. Laipni lūgti. Ja, manuprāt, šis ir tiešām ļoti, ļoti svarīgs notikums Latvijas ekonomiskajā dzīvē. Proti Eiropas līmeņa diskusija par to, kas notiek finanšu tirgos Eiropā, pasaulē, Latvijā. Ladies and gentlemen, welcome you to the annual conference of Latvijas Banka on economic and financial issues, and I'm extremely happy to see you here. And let me kick off today's conference with a short introduction on some of the things that I think are extremely important for the Latvian, for the European, and the global economy. 16 years ago, in the introduction of his book, The Ascent of Money, Scottish historian Neil Ferguson noted that the ascent of money has been essential to the ascent of man. And he went on to claim and later to prove that, and let me quote, financial innovation has been an indispensable factor in man's advance from wretched subsistence to the giddy heights of material prosperity that so many people know today, end of quote. In other words, financial markets have been playing a very important role for economic growth and well-being of our societies. And we have every reason to believe that this will play into the future. Last year, the title of our conference was A Recipe for Economic Growth. We examined the reasons behind the sustained slowdown of European growth. We looked at the key reasons for that, and we looked at the economic policies that may help to revive growth and improvement in living standards. We saw that there is no unique path to prosperity, but we saw that it's important to do things. And that was the key conclusion, structural issues. Unfortunately, we will also see these issues being very dominant in the financial markets in our today's discussion. Given that last year the mandate of Bank of Latvia was extended to reach into the regulation and supervision of financial markets, it is a logical next step for us to zoom into the role of financial markets in supporting sustainable growth. And I want to stress here the word sustainable. Sustainable is very important. And therefore, today's conference, which we are organizing together with our good colleagues from SUERF, is titled Financing a Better Future, the Vital Role of Finance in Achieving Sustainable Growth. When we set the title at the beginning of this year and the contents of today's discussion, we could not have foreseen that it would take place just 3 weeks after Mario Draghi presented his report on the future of European competitiveness. The arguments presented by him on the role of financial markets and the importance of financial markets could not be timelier. The annual additional investment that would be necessary for the European economy to face the challenges of defense, the challenges of innovation, of artificial intelligence use, of investment in general, adds up to about 4.5% of GDP annually for the next 6 years. So this is a massive amount of money. Financing such unprecedented additional investment would require a massive change in the design and structure of the EU financial market. It would need to become much less fragmented than it is today. It would need to become much more integrated than it is today. It would need to become much more diverse in the market players scene. We would need to see many more active market players, and it would be, at the end of the day, less dominated by banks. Completion of the capital markets union and the banking union is, of course, of extreme importance to reach the same. But I would also say that in addition to all these elements, it is extremely important to make a note that perhaps one other element is extremely important to consider and perhaps most difficult to implement. And that is our mentality, the way we think, the way we act. And let me give you just one example of this. EU households save more than their US counterparts. Yet, EU households have less wealth than those in the US. This wealth disparity is largely due to the lower returns that we receive from financial markets on our asset holdings. In financial markets, risk and return go hand in hand. In Europe, we tend to take very little risk. And of course, it leads to much lower returns. We tend to invest into government bonds. We tend to hold money in deposits at our banks, but we do not invest in equities. Americans do. And this particular situation reminds me of a personal experience which I want to share with you today. One day, quite a few years back, I went on a boat trip with friends of mine, just nearby here in the Gulf of Riga, a couple of hours of sailing. And when we were leaving the harbor, we saw that there was a boat nearby, and people were arriving, and it seemed that they're going to do approximately the same. You know, they're going to go sailing. When we returned a few hours later, we saw that the boat is exactly in the same spot where it was when we left. It was full of people. People were enjoying their time. They were having drinks. They were having discussions. They were having food. There was party going on, which is fine. But apparently the boat had never left the harbor. And unfortunately, this analogy also plays a bit, at least in my view, to what is happening in the Latvian, but also Baltic, also Central and Eastern European financial markets and banking system as such. So examples of such parties on boats, if I may call them, can be seen across Europe. It's not specific to Latvia or our neighbors in Lithuania. It's a wider phenomenon. And Latvia, in this case, presents just an extreme example of this. After a much-needed adjustment following the boom and bust cycle of mid-2000s. Unfortunately, in my view, it seems that we've stuck in a bad equilibrium. The ratio of loans to GDP has gone down from about 100% at the peak to now 28% to GDP. Although 100%, of course, was too much for a young economy like Latvia in 2008, but I would say that 28 is certainly too little for an economy like Latvia, what we see today. The loan-to-deposit ratio has gone down to 0.7 from above 2, which means that for every 10 euros of deposits, we only have 7 euros of loans. In contrast to the situation 15 years ago, we have savings. But these savings are not being efficiently transformed into productive investment, neither in the amount nor the scale needed to meet the challenges that our economy faces. And let me remind you that this is not only the challenge for the Latvian economy. These challenges are seen all across the European economy. Of course, there have been counter-arguments that, compared to the times prior to the global financial crisis, our financial system now is very safe, which is good. We need a financial system that is safe. But I would say that, of course, we also need a financial system that is healthy. And here I want to come back to the sailing story that I just gave to you. The safest place for the boat, of course, is in the harbor. But boats are built to hit the open water and go out into the sea. Of course, as anyone with any experience on the water knows, I'm not advocating for going out on the sea without life jackets, without a radio or without extra supplies in place. I'm not calling for a return of reckless lending practices of the 2000s or going back to serving high-risk foreign clients that have landed us into trouble in the past. But I want to reiterate that if we are to reignite economic growth and finance our fair share of the necessary future investment, it is very vital that banks take calculated risks and manage those risks appropriately instead of avoiding risk. And to carry on again with the sailing analogy, just like there are ferry ships, there are cargo ships, there are sailing boats, there are tugboats, a healthy financial market needs to go beyond banks. We must have full range of financing options, venture capital, private equity, IPOs, debt securities, to mention just few. We need a healthy, alive and kicking infrastructure and ecosystem of financial markets. Ladies and gentlemen, a strong Europe requires a developed and integrated financial market. We need more competition, we need more agile financial markets. But for it to take shape, it first and foremost requires political decisions at the EU level to reduce financial market fragmentation along national borders. Think of capital markets union, think of banking union. All these are very important for more efficient and productive financial market and our economies. This is the way for us to unlock the might of our financial markets. This is for the society to benefit and improve their living standards. If Europe is strong, Latvia as part of it is also strong. European-wide solution is the first best solution. Economists use the ranking of first best, and political decision is by all means the first best. Of course, there are second best solutions. Okay? And we, at the Bank of Latvia and other central banks and supervisors, of course, are doing their job to improve the vitality of financial markets. But these will always be only second best. The first best is a pan-European political decision to reduce the fragmentation of financial markets. One thing is clear, neither in Europe as a whole nor in Latvia can both stay in the safe confines of the harbor if we want to meet future challenges and grow our incomes and well-being in a sustainable manner. That does not mean that we need to put our head out and sail into stormy weather, or go close to cliffs or sandbanks, or resume transporting dodgy cargoes. No, this is not for us. However, we do need an agile fleet of ships that are best suited for different purposes, and we have to get back into the sea. So, let us discuss today how to cast off our ropes, how to hoist our sails, and how to hit the open sea. Thank you, and let's have a lively discussion of how we can improve. Thank you very much.
Thank you very much, Governor. And we have a second set of opening remarks from the Executive Vice President of the European Commission, Valdis Dombrovskis. He couldn't be with us today physically, but he recorded the remarks. So colleagues, please show the video.
Labrīt, Rīgā. Darba pienākumu dēļ man šodien jābūt Briselē, bet esmu pagodināts jūs uzrunāt virtuāli. Latvijas Banka un tās komanda man vienmēr ir īpaši tuva, kā man bijusī darba vieta un kā institūcija, kas stiprina Latvijas un Eiropas valūtu, ekonomiku un konkurētspēju. Honorable Governor Kazāks, Vice President Guindos, ladies and gentlemen. It is a pleasure to open the 2024 Economic Conference organized by Latvijas Banka and European Money and Finance Forum SUERF. Today's world is very different to just a few years ago. While we managed to withstand the COVID-19 pandemic, we are now have to deal with Russia's relentless war against Ukraine on our doorstep and in its third year. This aggression challenges the democratic world and its ability to prevail over Russia's sense of imperialistic impunity. These major shocks have particularly affected the EU economy, and they still do. Along with our need to continue supporting Ukraine, we must also tackle long-standing challenges related to our productivity growth and competitiveness. They will be key objectives of the incoming European Commission to boost EU's sustainable prosperity and competitiveness. They are also relevant for Latvia, of course. I'm sure Luis de Guindos will say more about this very soon in his keynote address when he discusses economic challenges. One thing is certain, however. Achieving our objectives in energy security, the digital and green transitions, defense, among others, will require a great deal of financing, combining public and private investment. On the public side, financing reforms and investments, for example, through the Recovery and Resilience Facility, is paramount, both now and in the years ahead. High inflation and supply chain disruptions have strained the implementation of some RRF projects. In Latvia's case, given the tight deadlines, implementation of certain milestones and targets in the Recovery and Resilience Plan should be accelerated. This will bring about structural changes to Latvia's economy, improving its competitiveness, resilience, productivity, and innovation capacity. It is also essential for Latvia to speed up implementation of 2021-2027 cohesion program. Public funding should also leverage investments from private sector, on which we rely for much of the financing needed. The EU will need to generate a great deal of risk capital to stimulate innovation to boost its competitiveness and growth. This is why we need deeper and more integrated capital markets. This will also broaden options for our companies to access diverse financing resources. As you know, in Europe, companies usually obtain most of their financing from banks. But in many cases, bank financing is not enough or difficult to obtain. This applies especially to young, innovative companies that need other sources of financing to allow them to scale up. It is a particular issue in smaller economies such as Latvia, where finance availability is limited. The result is that companies often scale back investments and growth ambitions. In turn, this holds back Latvia's economic development. There are several reasons for the sluggish lending activity. Loan interest rates in Latvia and other Baltic states are generally among the highest in the euro area. These countries also have some of the strictest collateral requirements, and the situation is made worse by limited competition in Latvia's credit market. Bank credit in Latvia remains relatively low. In the first quarter of 2024, as bank itself has said, the balance of issued loans for non-financial corporations and households was only 27.5% of GDP. In the euro area, the figure is 78.9%. Bringing more competition into Latvia's banking sector is essential to increase companies' access to finance. Boosting the single market for financial services would also make it easier for local companies and SMEs to tap into capital markets and access various types of funding both at home and abroad. This is, of course, one of the core objectives of the Capital Markets Union, and its completion will be a priority for the next European Commission. Regional initiatives can help too. Here, a pioneering example is a pan-Baltic capital market to boost regions' economies. Setting up common market infrastructure in the Baltic countries is a trailblazer for wider capital markets integration in the EU, along with their efforts to align rules in securities offerings. I trust that your conference today will debate these and other leading issues. Hopefully, it will come with some more ideas on how to enhance the funding opportunities for Latvia's as well as for Europe's businesses and people. I will conclude here and wish you a successful and stimulating conference. Thank you. Paldies un veiksmīgu konferences darbu šodien.
Thank you to Valdis Dombrovskis, and in a way he made my job now a bit redundant because he already let the cat out of the bag. But well, let me just say that the next speaker, those of you who watch at least occasionally, I hope you do, the ECB press conferences after the monetary policy meetings, so you will recognize him immediately. But there he actually doesn't usually do much speaking. He usually answers just a couple of questions because most of the speaking is done by Christine Lagarde, the president of the European Central Bank. So we decided, knowing that he has a lot to say, we decided why don't we give him the podium all to himself. So ladies and gentlemen, please welcome the Vice President of the European Central Bank, Luis de Guindos.
Thank you very much. Good morning, everyone. Let me start, if I may, thanking the Central Bank of Latvia, and especially you, dear Mārtiņš, for this invitation. It's a pleasure to be here. I'm going to talk today about how to revive productivity growth in the euro area, a critical challenge that demands urgent attention and collective action. I would like to start by outlining recent economic developments. After more than a year of stagnation, economic activity in the euro area recovered mildly, very mildly, in the first half of 2024, with considerable variations across countries and sectors. Growth, however, was weaker than expected in the second quarter of the year. The euro area growth outlook was revised down in September compared with the June Eurosystem staff projections, with risks to growth remaining tilted to the downside. Looking ahead, we expect a recovery to strengthen over time as rising real incomes and the gradually fading effects of restrictive monetary policy should support consumption and investment. Exports should also continue contributing to the recovery as global demand picks up. The recovery should be underpinned by an expected recovery in productivity growth, which has been particularly weak since the onset of the pandemic. Weak labor productivity can be partly attributed to cyclical factors, especially given the relatively rigidity of the euro area labor market, where employers do not fully adjust their workforce at times of low growth, resulting in labor hoarding. Cyclical factors that incentivize labor hoarding are expected to gradually diminish, leading to a recovery in productivity. However, productivity growth has not only been dampened through cyclical channels, it has been decelerating for decades in the euro area, mirroring a broader global trend. This structural weakness has been a significant drag on economic activity and continues to constrain medium-term growth prospects in the euro area, particularly in light of demographic developments. The population is shrinking and our societies are aging. So sustaining the workforce will rely on higher participation rates, especially among women and older people, alongside well-designed immigration policies to address labor shortages and support long-term growth. But allow me to delve deeper into the core drivers of this sluggish productivity growth, particularly in comparison with the US. Over the last 30 years, the productivity gap between the euro area and the United States has widened considerably. This divergence has been driven by relatively weak total factor productivity growth in the euro area, and since the global financial crisis, insufficient capital deepening. To understand this productivity gap, we must look at the structural challenges we face. As Mario Draghi highlighted in his recent report, one key issue is that Europe largely missed out on the digital revolution. While the United States capitalized on its high-tech sector, many of the euro area's most productive frontier firms are concentrated in mid-tech sectors with limited potential for productivity growth. The divergence is not due to the level of public research and development expenditure or the quality of our research, but rather to sectoral specialization and the lack of coordination in investment and innovation policies across member states. Total investment ratios, both private and public, as a percentage of GDP, are also lower in the euro area than in the United States. Despite an increase in public investment since 2020, driven by the Next Generation EU initiative, there is still a substantial gap in private investment, particularly in the areas of R&D, digital innovation, and digital uptake. The decline in total factor productivity growth among high-tech frontier firms in the euro area partly reflects their age, as older firms are typically less productive. Moreover, a secular decline in business entry rates and the winner-takes-all dynamics of new technologies have reduced competition, limiting the process of creative destruction needed for productivity growth. In the services sector, a widening total factor productivity growth gap between leading and lagging firms suggests that the adoption of new technologies by non-frontier firms, particularly small and medium-sized enterprises, remains sluggish. The European ecosystem of small and aging firms struggles to compete globally. If we do not act quickly, their comparative disadvantages will only grow in this era of rapid technological progress. Our firms face scaling up, as Valdis Dombrovskis has indicated, challenges, skill shortages, and framework conditions that are not conducive to radical innovation, but instead favor marginal improvements in mature technologies. Business dynamism is stifled by intricate regulations and overlapping governmental institutions and tax systems. This restricts the creation of innovative firms and the reallocation of resources to the most productive, undermining productivity growth and competitiveness. These complexities are amplified across national borders, further limiting the ability of European businesses to scale up. Europe's productivity would be higher if more innovative firms had a better environment. Since its inception, the single market has made significant progress in fostering growth and convergence across Europe, but the environment for innovative firms still leaves much to be desired. Enrico Letta's recent report offers a comprehensive perspective on the single market, highlighting the as-yet untapped potentials. His proposals to streamline the regulatory burdens, favor regulation instead of directives for greater harmonization, improve administrative capacity, and introduce a European business code of the 28th regime merit particular attention. A larger and more integrated single market would call for a single, deep capital market to finance the EU's competitive firms. Greater economic integration in the EU will bring greater financial integration. Numerous proposals have been made to develop the Capital Markets Union, and the ECB's Governing Council issued a statement on the topic in March 2024. Let me first focus on the proposals aimed at fostering the growth of competitive European firms. As companies progress, they require diverse sources of financing and need to be connected to stakeholders who can best support them through their growth phases. However, Europe's financial system is predominantly reliant on bank lending, which is not ideally suited for financing young, high-risk firms. During the scaling up phase, in particular, innovative companies need access to risk capital and investors with the network's experience and risk tolerance to allow them to experiment and potentially fail. Venture capital funds are particularly well suited for this purpose. However, the venture capital market segment in Europe is underdeveloped. As a percentage of GDP, venture capital financing in Europe is a third of that in the United States. In addition, individual EU venture capital funds are smaller owing to a fragmented market. This has direct consequences for firms. Not many EU venture capital funds are large enough or have deep enough pockets to meet firms' financing needs or cope with the high failure rate of startups or young high-risk firms. It is not uncommon to see failure rates of 80% for risky frontier tech investments, for example. If firms need to seek funding in countries outside the EU, such as the United States, their activities can end up being relocated abroad, affecting Europe's economy. Companies that source foreign funding in the later stages of their scaling up may then be listed on foreign exchanges, further depriving Europe's equity markets of large and innovative firms that contribute to the market's depth and liquidity. The recent listing gap between the US and Europe is due, at least in part, to the greater attractiveness of the US stock markets for foreign firms. The percentage of foreign companies among all companies listed in the US rose from around 18% in 2017 to 24% in 2022. By contrast, foreign listings in European markets have shown a slight downward trend over the same period. Europe lacks a single, sufficiently deep and liquid equity market where firms listed in the US could aim for similarly high valuations as those they can currently aspire in the United States. The average market capitalization of US companies has historically been much higher than that of European companies, with a gap having widened significantly since 2010. In 2022, US companies achieved, on average, a market capitalization that was 3.3 times higher than that of the EU companies. Overall, Europe's underdeveloped venture capital environment, fragmented equity markets, and heterogeneous national markets are leading to higher financing costs and inefficiencies in the allocation of capital when compared with the United States. To overcome Europe's private investment gap and give European firms access to the financing they need, especially in terms of equity, we need a more ambitious agenda for both developing and integrating EU capital markets. First, household savings should be directed towards capital markets. A retail saving product that offers tax incentives and could be sold across the EU could be a step forward in that direction. The same goes for lowering the entry barriers for retail investors to participate in equity and bond markets. Increasing the share of equity investments in funded pension systems would also have mutually reinforcing benefits. It could give institutional investors, such as pension funds, a greater role in providing a large investor base for equity markets, similar to the role they now play in the US. Ensuring the portability of pensions across borders, as envisaged when launching the Pan-European Personal Pension Product, will also be fundamental in supporting the single labour market by enhancing mobility for workers in Europe. Second, regulatory action can encourage investment in equity by addressing the debt-equity bias in taxation. Simplifying regulation can attract investors, promote risk-taking by Europe's companies, and boost cross-border market developments. And third, the To develop the equity market, we need to make listings in Europe more attractive and efficient. To this end, we should aim to create a single pool of liquidity for public equity markets that would provide sufficient market depth to issuers and investors. This requires deeper integration in the trading and post-trading landscape, further harmonization in difficult areas like insolvency regimes, accounting, and securities law, and finally, more centralized supervision for systemic cross-border entities, including stock exchanges and market infrastructures. Where political agreement on harmonization is not yet reachable, intermediate solutions mentioned above before, such as the 28th regime or enhanced cooperation, should be regarded and considered. A way of deepening the securitization market could be to set up a European securitization platform. Besides fostering standardization, this could support the development of green and other segments while maintaining a sound prudential framework. Finally, public-private partnerships will be critical in future for stepping up investment in innovative firms and the green and digital transitions. The complementarity between public and private investment leads me to the final point on the need to mobilize fiscal resources at the EU level. The EU needs a massive amount of investment and financing to close the productivity gap and support the digital and green transition. Europe has to reflect on how it can use targeted public investment to help meet these financing needs. The EU and member states should explore a reorientation of the EU budget, as well as options for jointly funding investment in specific projects. The Recovery and Resilience Facility was a step in the right direction. But the RRF is a temporary tool, and once it elapses in 2026, the EU budget will shrink significantly owing to the cliff effect. We should be determined to permanently enhance the EU's fiscal capacity, also to support cross-border and pan-European projects. This could include the provision of European public goods, such as energy, infrastructure, innovative technologies, and common defense, further strengthening risk sharing by ensuring that key investments take place even in adverse macroeconomic conditions. Besides common spending, essential elements for supporting innovative projects are well-targeted subsidies and a cohesive European industrial policy. A level playing field needs to be restored, fully phasing out the state aid temporary framework adopted during the pandemic. Let me conclude. Broadly speaking, the problems we are discussing today derive from the incompleteness of the economic and monetary union. Greater integration in the market for goods and services, as well as in the capital and labor markets, are essential for success of the European project. The recent high-level reports from Enrico Letta and Mario Draghi correctly emphasize that the key to Europe's success is the leverage on all aspects of EU collaboration and coordination, including the completion of the single market. Regarding the topic of today's conference, advancing on the agenda for the Capital Markets Union will require efforts to dismantle the barriers to enlarging segments of the capital markets and provide the financing needed by innovative firms to develop throughout the cycle. But the Capital Markets Unions alone will not deliver those benefits if economic integration is still in the starting blocks. The single market remains fragmented, the banking union is not yet complete, and EU industrial competition and trade policies are not part of an overall EU strategy. This calls for an ambitious and comprehensive agenda with a more focused Europe. To reignite European productivity and competitiveness, ensure sustainable growth, and rising living standards for all European citizens, the EU response must be determined, coordinated, and comprehensive. Thank you very much.
Thank you so much. One of the benefits of having SUERF as your cooperation partner for the conference is that you get a SUERF council member to moderate a panel discussion. And of course, she's much more than just a SUERF council member. To me, actually, she's one of Europe's top economic analysts, and I must say to you one thing. If she has a contrarian view to the mainstream, so you better watch out, because there are high chances, high probability that she will be right and not the mainstream. So the group chief economist of Societe Generale Group, Mikaela Markusen, please welcome. Over to you.
Thank you very much, and good morning, everyone. It's my pleasure also to invite the rest of the panel to join the discussion. And I'm looking forward to welcoming Carol Lanu, who is the CEO of the Center for European Policy Studies. Also, Rim Ayadi, who is professor at the KAS Business School. And am I missing a panelist here? Excellent, sorry. And we can see her on the screen now, Tatiana Panova, who is head at the Capital Markets Union unit in DG FISMA. So welcome, everyone, and thank you for joining the discussion today. Vice President, listening to you, I must say I was a little bit worried, because drawing on the analogy of the boats and the harbor, it seems that we can see the exit from the harbor, and yet it seems that we're having a hard time to decide to get out of the harbor. Now, obviously it's a long time ago, but I remember as a young economist, we were super excited about Europe. You know, it was the time of the single market, at the time of the euro, and you know, it was also exciting. And you know, at a very personal note, my husband is French, and at the time, you know, calling France was super expensive. It cost almost €1 per minute. Maybe this is the success of a happy marriage. We didn't talk too much in the early days. But then we had the whole liberalization, and telecom became cheap, and air travel and travel became cheap. What do we say to young people today to be optimistic about Europe and looking forward? Where can we see this coming?
Well, I think that in order to be optimistic, what we have to do is to look what happened in Europe in the 20th century. The situation is totally different now. You know, we started 2 world wars in the 20th century, and now, you know, well, Europe is, you know, we are talking about further integration, political cooperation, and I think that this is a very important step forward. I used to say when I was finance minister of Spain that normally in the EU, in the euro area as well, we used to explore all the alternatives before taking the correct one. But finally, eventually, we took the correct one, and I hope that that will happen in the future. So it's quite clear that we have difficulties. Our geopolitical situation is not easy. We have the war in Ukraine, we have the situation of the Middle East, we have the challenges from China and the situation and what might happen with the elections in the US. But I think at the end of the day, Europe continues to be Europe. And Europe, you know, is one of the most relevant jurisdictions in the world. And for sure that at the end of the day, we will take, you know, the correct decisions. So I would be optimistic, even though you know, the way to take, you know, these correct decisions, that in my view is only, you know, additional integration, is going to be paved with difficulties. But I am sure that we will be able to do it.
So we've called our session today from Riga to Brussels to Wall Street, and I think we need to include Frankfurt on the list as well. But maybe what I'd like to do is just kick off in Brussels with you, Tatiana. When I look at the ECB statistics on financial integration, so we have them both for price and volume. Price tends to be a bit volatile and moves around with the cycle, but what's really striking is when we look at the ones on volume, we saw a significant increase for many, many years. And then we flatlined, we went back a little, we came back a little, we flatlined again. It seems that we had some momentum in those early days, and it seems that that momentum today has been lost. So sitting in Brussels, what would you say we can do to secure some durable progress here and get back this momentum?
Thank you very much for the question, and good morning, everyone. Apologies I couldn't join you directly, but Brussels is often on strike. So that's of course a very interesting question, but I would like to challenge you a bit, right? You said that there was flattening of the curve, so to speak, but it depends on how the curve is measured and what the curve represents. And let's not forget that the curve has been affected by many different things. So if we take a step back, because Lewis took back almost 1 century ago perspective, I'll take maybe 15-year perspective or 10-year perspective. When we look at the banking union, how the banking union was created as it was a baby of the crisis, you know. There was an urgent need, everyone agreed, politically it was a must, and that's how you got supervision, resolution, so everything went really smoothly until the point when the crisis was over and there was all of a sudden less desire to work on the common deposit guarantee scheme, of course. Now, in the CMU case, in the Capital Markets Union case, there was no crisis, no explicit crisis at the beginning. It was all part of the growth agenda. So the idea was, okay, we need a positive narrative. We need to spin the whole, financial services agenda with a new angle. And to be honest, we didn't even need CMU that much. We didn't really need integrated capital markets at the time because we had the City of London, which was the European single integrated market based in London. And provided everyone had access to it, it was all right. And then all of a sudden, lots of things happened. Brexit happened, and then a few challenges happened. You know, we've got the new agenda on sustainable, digital. There was COVID, there was energy crisis. And all of a sudden, CMU was no longer this nice to have, positive agenda, a growth agenda type of project. It became almost akin to the banking union agenda because it became part of the crisis agenda. So what you're calling the flattening of the curve is actually not necessarily a sign that there is less relevance for the CMU. And what we see today in Brussels is actually a renewed momentum for CMU, because I think there is a new realization that we are slowly but steadily, and I think Mr. Draghi called it a slow agony. I would not use that term, but to be honest, I fully agree with him. We are steadily moving in the direction of a crisis, which may be not as acute as in the case of the banking crisis, but is as important because we have a big, huge issue of competitiveness that we are struggling with. I think Luis de Guindos has just called the EU as the most relevant jurisdiction. I would like to question that. Are we the most relevant jurisdiction? And can we continue being the most relevant jurisdiction if we cannot support our productivity, if we cannot support growth, because there's simply not enough investments? And yes, there was a talk of savings. Yes, we save a lot, but it doesn't go into productive investment. And that's basically where we are today. So I think there is actually political momentum, but I'm happy to go into further detail then. And what you see in terms of flattening is not necessarily something that is reflective of that political momentum and something that would be reflective of all the things that have been done, because on the way you had lots of crises that partly negated some of the effects of the measures that have been taken in Brussels, but not only, also in national capitals.
So thank you very much for those comments, Tatiana. And I just want to quickly take the opportunity to remind the audience that after we've done a first round, we'll open up to discussion. So please do ask questions. I've been given this wonderful iPad, and I believe that the questions will show up on it. So please feel free to add questions or share comments, and we'll be able to pick up on these topics. So a little bit of hope to regain some momentum. Fingers crossed, I hope it happens. And indeed, I think it's quite challenging. But one of the things, of course, and we have it in the title, Wall Street, is always to look across the Atlantic and study the American model. What strikes me, Carol, and I wanted to ask you about this, is when we look at the American model, it seems to me that there's so much more public risk sharing in the US model than quite often we appreciate. Just looking at the American capitalism, the American markets. Tatiana, you mentioned deposit insurance. It's also the pension benefit guarantee scheme. But it goes beyond this. It's also support for the securitization markets from all the government-sponsored enterprises. We often think of the mortgages with Fannie Mae and Freddie Mac. But then, of course, it's also about the support for the small businesses with the Small Business Administration. And then there's the elephant in the room with the single safe asset, US Treasuries. Carol, what can we in Europe learn from the US? Can we take inspiration? Should we seek to copy the US model? Do we need to do things differently in Europe? What can we learn and what can we take away? And are there any kind of quick ideas we can grab from the Americans here?
Thank you. Pleasure to be here. Thank you, Governor. Say that I can share my voice. For those who do not know SEPS, we are an independent think tank, so we're not linked to the institutions, so we can say what we think should be said. On this comparison between the United States and Europe, of course, one of the problems is the eternal benchmark. If you look at the Draghi report, it's always the comparison with the United States. And I think we've known this for 30 or 40 years even, let's say. We have been started, the single market was started with the example of the United States. And if you know, look at the Letta reports and at the Draghi reports, the eternal comparison is always the United States. Of course, we all know, let's say, that there is huge differences between the United States and Europe. But when I read Letta, when I read Draghi, I mean, certainly when I read Letta, I see, look, we need more Europe. And I think one of the big things which we see, of course, we say, US has a lot of government support as well. The big issue, for example, if Draghi compares research and innovation, certainly spending by the states in the US and the EU, state-level spending on research and innovation is the same in the US as it is in the United States. The problem is it's dispersed in Europe. I think 7 or 8% of R&D spending in Europe, state spending, is done by the EU. The rest is done by the member states. If you are spending, for example, now on biotech, I mean, as governments, or on AI, or on other technologies, or on, more basic forms of R&D, if it's dispersed, of course, you will miss things. And of course, the EU has also started to create institutions to cope with this, the Joint Research Council and other entities we try to coordinate. But if the funding is not there, of course, it's extremely difficult. And we have seen this, by the way, with the COVID crisis as well. Let's say you had to react to a sudden crisis. We didn't have instruments at European level to say we need to now all of a sudden rapidly foster research in, for example, vaccines research, which we didn't have at the time 4 years ago. Yes, exactly 4 years ago. And that's why, of course, this joint spending is much more important. But then it depends, Michaela, what you compare. Of course, there are certain ways where the US is much more probably on a federal level state than it is for the EU at EU level. But if you look at the member state level in the European Union, we see there is a lot of levels of support. And what I hear in Brussels, certainly in reaction to the IRA, the Inflation Reduction Act in the United States, when all of a sudden, November 2022, the debate started in Europe, we need to have something similar in Europe. We did at SEPS the compilation of the statistics, say how much support is there at European level compared to United States level. We have in Europe even more than in the United States. The paper is on our website. It was done by 3 colleagues. The thing is just, again, companies say we still go to the United States for support, for example, under the IRA program, because it's a one-stop shop. And the one-stop shop was the example which was made when we created a single market. We need to have a single license, a single authorization to have the capacity to have this single funding. Whereas in Europe, it's at EU level, state level, and regional level. So, of course, if you're a company, you need to have all these different levels, plus the Vice President mentioned the taxation issues. You have different, certainly at state level and regional level, some different levels of taxation, of kind of credits on taxation. Of course, this is kind of extremely difficult for companies to do. But let me also say that one of the important elements we need to see that if you're not sufficiently of a single market, the blame is often put on the state and on the member states and on the EU institutions. Very often, it's corporations which prefer often to have fragmentation, to kind of play the one against the other. And if you're here in the Baltics, one of the things which surprised me recently, we speak about the capital market union, but I see, for example, Nasdaq, which is the operator in the Baltics of the stock exchanges, because we have Euronext and many different other European countries of the stock exchanges in, for example, Belgium, the Netherlands, France, Portugal, Italy. We see that these stock exchanges don't use the single license. So we have opportunities in European law to make sure that you can have a single access, that have a single point of entry, but it's not used. So I wonder why. Why has Nasdaq got 5 different licenses in the 5 different markets in which they're active? Why has Euronext got 7 different licenses rather than 1? And of course they say, we offer the possibility to have a single virtual trading platform. It's not true. It's 7 different pools of liquidity. So if we want to have liquidity pooled, it's not only we in Brussels who have to regulate, try to harmonize everything. No, it's the enterprises which have to say, look, we will use the benefits and really make sure that we exploit the single market to the maximum extent. But very often they don't dare to do, or they don't want to do, for whatever reasons, for the reasons I just mentioned, that they want to try to exploit these different sources to basically, in their own benefit, have probably more revenues. But in the end, who pays the price of this? All of us.
I think these are very important points, and I mean we see this fragmentation also in the bank market. I was looking at the ECB statistics on the lending rates for consumption, and I hope I got these numbers right. 13.61% here in Latvia, 7.77% in the euro area on average, 6.4% in France. I just chose France because that's where I'm based, so a little bit of a bias there. France is not the lowest. I believe it was Malta, if I remember correctly. But you see this very big spread in the lending rates, and indeed, I think we can debate, why is the banking union still so fragmented? Is it because we're not able to exploit the full opportunity of the banking union, even though it's incomplete today? Or is it something else that's at play?
Yeah, it's correct. It said the banks as well don't use the single license. The banks could also pool liquidity, and they don't do it because they probably benefit also from the fragmentation. We heard the governor saying, let's say, the spread in the interest rates. If we were to have more liquidity pooled, probably we would have less of the spreads, as we've seen certainly in a country like Latvia.
And I think if you were to ask the banks a question, you would also get an answer about sometimes the tensions between the national regulators, the national institutions, and the European ones. And of course, we have a kind of live test case at the moment, which we won't bring up too much on stage today. But it'll be interesting to see what happens in this particular story. If anyone wants to jump in, please do. But before we do, we start to see, Rim, a discussion here on where is the problem? Is it the private sector? Is it the public sector? And I know one of your specializations is about state intervention. How much should the EU level, how much should the national states intervene to make sure that we get the benefits of the institutional structure which is already there, which it sounds as if it could be one of the areas of opportunity here, at least to push to the maximum within the existing system?
First of all, good morning, everybody. Thank you for inviting me, Governor and colleagues from SUERF, in this very important event. Before I go into particularly the state intervention, I want to just say one thing, and also the conference today, Financing a Better Future. The future is very uncertain, and uncertainty is heightened. So it means that perhaps the models that we have developed previously, they may have to be adjusted and look at the scenario analysis to understand really which are our view of the risks that we will have in the future. Because first of all, we're living a multitude of transitions, not only the digital one, and it is going extremely quick. Also the climate change breaks, which are also going very, very fast. And also the social changes that we are not talking about, but these are the demographics of our societies. We are going into aging population, and we have not yet prepared for the risks that are entailed, in fact. So it's still very uncertain. And fourth and foremost, I think it's not the least, but it's also very important, it's the change in the geopolitical scene. Before, it was very clear, we have this US and Europe, and these are the benchmark that we've been following for many years since the Second World War. But nowadays, we're moving into a geopolitical environment which is completely uncertain, very tensed, and that's why we see the frequency of the wars, or what we call the man-made disasters. So we have the disasters that are also man-made, that are in the planet, but also the provoked ones via the wars, the conflicts, the tensions. And all of this is increasing the cost on humanity overall. So not only on a specific sector or specific region. So financing a better future, sometimes I think what future in an uncertain scenario that we are going to finance. The risk profile globally is going up, and this is also, we cannot complete or continue working on models which are pricing risk over the last years or probably 20 years ago. I think we need to also accept the fact that our risk models have to be adjusted to tail risks. And we've seen it, for example, in terms of the insurance and reinsurance market, and we've seen it every day. There are some tail risks nowadays that are not insured anymore, they are outside. So there is a gap, an insurance and reinsurance gap. Companies that are supposed to, in a way, private companies that are supposed to insure tail risk, they are not doing it anymore because it's very heavy on the provisions on the insurance situation in their balance sheets. And then, of course, we can even face further bankruptcies in the insurance and reinsurance market. And this is what we don't want as a society, because at least these are the insured risks. So there is the amount of uninsured risks are going up tremendously. And we need to, as soon as possible, try to understand what are the scenarios as society, as Eurozone, as Europe, as whichever other region we are facing. So going into state intervention, I think 10 years ago, I wouldn't do this speech. I mean, I wouldn't say that we need government intervention. Of course, I'm a liberal economist, and I think all my life I've been thinking that less intervention is better. And then nowadays, I think that at the point in time I worked, in the time I said regulation is important, but it has to be commensurate to the risk and to the costs. So it shouldn't be excessively compliance-based and very costly to the society, because somebody has to pay for it. But nowadays, I think that we need to move into a complete different model where we have to face those risks. I mean, if we can, I would say, measure them. I mean, when I say risk, it's the part of the uncertainty that we can measure. So let's assume we can measure, because we have fantastic models, and nowadays with AI and artificial intelligence, in fact, artificial intelligence and big data, we are able to assess those scenarios and risk patterns. So how can we face those together? Means private sector and public sector. So there is no future without partnership and change of mentality between the public sector and the private sector. And I go back to what Karel is saying. Yes, Karel, I mean, there is still this tension where private players, they want to benefit from the inefficiencies. And also there's still some regulatory captures, and there are certain inefficiencies there in the market where, in fact, some players, they are doing it because they are stressed to have a bottom line at the end. They need to make profit. And then at the end of the day, we are still with the mentality, and I completely agree with the governor, say we have to change mentality. We need to think for the future of our planet, of the next generations, and then understand that we probably need to target those state intervention for the strategic purposes that we want to make for. For example, Europe nowadays, there is a huge gap in terms of investment in green transition. We need to face also the strategic autonomy. I mean, this has come after the war in Ukraine. We've seen that we are completely, in a way, dependent of other players, and those players are very uncertain because, you know, the geopolitics are extremely uncertain. So at the end, first investment in green transition, in digital transition, in societal changes. So there's so many, and the financial market is the backbone of our growth and competitiveness, globally and regionally, whichever whichever in which, I would say, region we're talking about. And this allows us, in a way, to rethink differently. How? We need to work together. So government intervention could serve when there is a market failure, that's textbook. But then at the same time, we know where there is market failure. The data is telling us, everybody has the data and access to data nowadays. We need to ensure that there are funds, and those funds have to be coordinated. I think what I learned from the pandemic is, for example, the Next Generation EU and all these funds that EU has put in place, and these are billions and trillions. They have served a lot, but they have to be better monitored, better, more transparent to the public, to the citizens, to enhance accountability. So we ensure also that the citizens are aware. We cannot change mentality if we don't understand. I mean, people have to understand the role of Europe, the role of the different players, and this is also important over time. So the financial market is the, I would say, the arm, I mean, of the European Union or of whichever US, which others. And we need to work together to ensure that this is not a fight. This is really going to face a future that we want for the next generation and for ourselves going forward.
Nicola, can I react to what Rima said?
Yes, please do.
And also Carol, because I thought that was interesting. I always like what Carol says because he's so passionate about different things. And I would not disagree with him because CMU or capital markets union or integrated capital markets are very different depending on whom you speak to. And if you speak to somebody in the industry, they would paint you a very different picture to the picture that would be painted by a governor of a central bank or even an investment firm, you know, in Paris or Frankfurt. So indeed, they have different versions of the CMU, but there's one thing they agree on. We need fit-for-purpose legislation. We need fit-for-purpose supervision. They have different versions of supervision, of course, but they all agree that it needs to be efficient and it needs to be really agile also because of the market development. To Rima's point, I was a bit perplexed, if I may, because you were talking about risk pricing on all of that, and you know that insurers have to price the tail risk. You're obviously not wrong, but should it be our task to think about those things? Because I think industry, and that's what I've learned working for many years in financial services, industry is extremely quick in adjusting. If there are changes, you know, crises, they constantly happen. Every time there's a different one, but there is a crisis almost every few years. I mean, we've seen there's always a unique crisis, but they do happen, and they do happen a lot, and industry adjusts. So what I agree with you is that I think there is a role for the regulator, for the state to come in to support when there is a market failure, when there is a particular big issue. But is it really the role of the public sector to come in constantly to be the lifeline? Because that's the risk. That's the risk. If you overregulate, if you try to overthink it, and you know, try to tell the industry in a very intrusive way how you should price this and price that, I think we're going to be very quickly down the rabbit hole. I think it's very important to understand where the role of, I think, regulation and supervision starts and where it should stop, and where the public support is necessary and where it's not, and where it becomes basically something that, you know, almost makes the industry dependent on it. And then we will have a version of capital markets which are not necessarily great. You don't want capital markets, private capital markets, to be dependent on public capital. So this is maybe a small remark that I wanted to say, but I hope I didn't misunderstand your intervention.
Can I just clarify? I said targeted, so that's why I didn't say generic. So this is important. So targeted, so it has to be very carefully managed. And there is a fine line, in fact, between between different interventions. So intervention or no intervention, we've seen it, for example, in the financial crisis, there has been an intervention, pandemic, there has been an intervention, and also in the war in Ukraine, there has been an intervention, economic intervention. So these are targeted, and it should not be generalized, but at the same time, we could eventually think of strategic intervention to promote certain markets that are underdeveloped, for example, energy transition or green energy transition or others. So it has to be targeted just to open the space to the private sector to be agile and vibrant over time. But if there is, in a way, we can redefine what market failure, for which purposes. So this is a strategic reflection that as society we need all to make.
So thank you for these things. We have quite a few questions. I have 28 actually coming in here. So I'm going to try and group them a little bit, and I apologize if I'm missing out on the specifics of individual questions. If we just look at some of the ideas coming in here, one theme that we see in a number of questions is the level of regulation we have in the EU today. Do we have the right level? Carol, you mentioned the multiple layers. And also there seems to be a bigger question on the regulation. And it sort of reminds me, sometimes we hear a bit this, which is not a very nice joke, but the US innovates, Europe regulates. Is there some truth to this? And perhaps, Carol, I can address this question at you on the regulation. Do we have some quick wins from maybe tweaking some of the regulation, getting more efficiency on this side?
If I look at capital markets regulation, we have been discussing this. We worked on this for a long time, since 1999. We sometimes say capital markets union is only 10 years old, but the EU has started to regulate in the domain of capital markets at the end of the 80s. With the single market, there was a second wave. We had, with the start of monetary union, with the euro in 1999, we had a third wave, the Financial Services Action Plan, and then we had the financial crisis, and then we have the capital markets union program. So it's already 5 waves of regulation, and we're still there. What is the problem is that basically member states, to some degree, always try to reinterpret, or what they call gold plate, let's say, had an additional layer of regulation, but also the EU doesn't enforce enough. Let's say we should be much stricter. That's why I mentioned also the private sector's responsibility. If we have freedoms of the single market, you have to enforce them. And enforcement is not only a task of regulators, it's also a task of the markets themselves who say, look, we have the freedoms, I want to have them. Like you mentioned the telecoms example. The telecoms firms exploited this. I mean, of course, you had to regulate first, but then thanks to competition, they exploited what there was just to lower the prices of the services. That's what we don't see sufficiently in financial markets. And a classic example is, Vice President de Guindos mentioned this, the back offices. Say we have securities transactions entities, which are called the CSDs, centralized securities depositories, of which we have far too many in the EU. We have about 27. If you add the ICSDs, there are 28 or 29. Formally, they are backed, they should be in competition with each other. There should be interoperability, like you have in the telecoms market. You should be able to make a call from one country to another and be served in the server of another telecoms company. In Europe, let's say for CSDs, this is not possible. You work basically in vertical silos. You do a share transaction or a bond transaction in one member state, it's settled locally. And there is no or very limited what they call interoperability. Interoperability means that there is competition between these different engines, like you have in the telecoms market, and that as a result, prices go down. But we don't have interoperability, or very limited interoperability between these, what they call securities depositories. If you have shares or you have a fund, the securities of this fund are held in this depository. But the depository charges a price to keep it there. If there is no competition between these depositories, of course they can charge prices which they want. As a result, the cost for you as a saver goes up. If you keep directly securities, or you keep it in a fund. And that's what, for me, one of the main issues why, for example, we don't have a single capital market, because we don't have a consolidation in these securities depositories, because sometimes member states say, because of safety reasons, it must be kept locally. Because of also the execution of monetary policy by the ECB, the bonds which banks keep as collateral must be kept locally. But as long as we don't integrate these different depositories, which are basically economies of scale business, like in the telecoms business, we will not have, let's say, price competition, and we will not have in the post-trade reduction of costs. And that is, of course, seen to be very arcane, but it's extremely important because these entities keep your securities and are the safeguard to say, look, you have these securities and these stocks, here is the proof. But if there is no pressure on them to integrate, they won't do. And of course, you see in the United States, by the way, if you speak about a state-sponsored example, we have the DTCC, you have one, or you have two. You have one for government bonds in the US, which is related to FedWire, and you have another one, which is called the DTCC, the Depositories Trust and Clearing Corporation. And Europe, every member state has one. And the EU has tried to integrate this, and there is laws on this, but basically, yeah, everybody thinks, yeah, let's keep it like it is. And in the meantime, we lose out. And that's the problem which we have today. In many things of capital markets union, as I said, there were 5 waves. We have been discussing far too long, and we have been acting far too little. So I have an article which I wrote about this. It's, we have been discussing this for too long. And in the meantime, the markets operators lose interest. And like an example which is well known in the Nordics, for example, Spotify is a Swedish company, went to the United States to be listed rather than in Europe. And by the way, Spotify, I think not many people know that Spotify is a European company, but its market value today is 65 billion. 65 billion is much more than many European banks, Michaela, you know, huh?
Absolutely. And I think when we look at this, I think in the Draghi report, it was mentioned that 30% of the European unicorns have gone outside of the EU, and most of them, of course, to the United States. So I think this raises a lot of questions on how we can keep the attractiveness. Looking over the questions, I think we're missing the Minister of Finance because there seems to be a lot of questions on the corporate taxation here in Latvia. But as we don't really have a Minister of Finance with us, apologies to those looking to have the corporate tax rate go down today. I'm not going to fix that for you. So we will hopefully have him another time to discuss this matter. But of course, when we look at the questions coming in, some specific questions which I think are important to the geography here, and I would like Vice President to bring you in on this, is getting financing to some of the smaller markets in Europe, closing some of these interest rates gaps, and also a bigger question for the EU on getting more access for the SMEs to have financing. What can we do to help on this? And you know, I really hope us to be specific and tangible here, and something we could do within the next year. I know it's a big ask.
Well, we are not the legislators. We have other kind of responsibilities. But let me say something, because, well, we are dedicating a lot of time to the potential improvements in the capital market union, and for sure that the question of fragmentation in terms of regulation, insolvency laws with different characteristics, the lack of a single supervisor. But perhaps, in my view, we are missing the main point. And recently, 3 months ago, we produced, in combination with the European Commission, the financial integration report. Financial integration report that we analyze, how the flows of capital among the different countries of the euro area. And the situation was really disappointing. We have not had big progress, even since the launch of the euro. Why? Because we have a single currency. And I think that perhaps, the reason why we do not have integrated capital markets, besides the point made that before Brexit, it was London, the city was the real capital market union for the EU. I think that the real point is that we do not have, a complete economic and monetary union. It's very difficult to have capital markets integrated in a single entity with with common rules if first you do not have, a common fiscal policy. Second, you have a variety of labor regulations among countries is very difficult. Because in the case of the US, you know perfectly, what's the framework that you are going to move there. If you do not have, a complete banking union, and I think that, we are going to discuss quite a lot about capital market union and, the potential failures in terms of the lack of single supervisor, the question of insolvencies, taxation, et cetera, et cetera, et cetera, et cetera. But at the end of the day, we do not have, a single good and services market. And I think that, my concern is that we will continue discussing about the capital market union. There is a lot of talk about capital market union, and afterwards there is very little delivery, because I think that capital markets will integrate once, the real economy in the euro area is fully integrated. So it's going to be, in parallel. I think that if you do not have a real single market, if you do not have, a real common fiscal framework, if you do not have a real, banking union, it's going to be very difficult. I think that, the comparison with the US, in my view, the most important element is the issue of valuations. Well, JP Morgan, the value of JP Morgan is identical to the market cap of the 10 largest European banks. And if you look, for instance, at the price to book of the European banks, that has improved recently because of the improvement in terms of profitability. Well, the price to book, the discount in comparison with the US is big. Why? And I think that there are several reasons. The first one is the growth potential of the US is higher than in the case of Europe. Second, we do not have a real banking union. The question of the taxation of the windfall profits of the banks gave rise to certain levels of uncertainty. But, when you have low valuations of your banks, there is one very important consequence, is that it's very difficult to increase capital, because the dilution of the shareholders would be huge if you have, price to books below 1. That is not the case of the US banks. So I think that perhaps, my point, and I come back to I think that here, the leading force should be the integration of the goods and services market, should be the single market. And afterwards, I am sure that if we get a real integration of, the real economy in the euro area, capital markets will follow suit.
So as you can tell from my introductory comments, I have a lot of sympathy for your points, and I completely agree with you. I think the single market is really a key building block here, and I fully share your thought that it's not just about creating a financing union, it's also about creating a real economy union, so that we see it across all the sectors of the economy, with the corporates, and these points were made in other areas as well.
But I think that we are missing a point. We are, for instance, labor regulations.
Absolutely, absolutely. And I think, one of the things that I often think about, and maybe Tatiana, I'm tempted to bring you in on this one, which is we talk a lot about financing the green transition. And then at the same time, and of course finance has a huge role to play in the green transition, but I think it's equally important that it's going to happen outside the financial sector. The financial sector on its own is financing a lot of emissions, but is not emitting very much itself. So it has to happen in the companies. Now there's a lot of, we now have a carbon border adjustment mechanism coming into place. But I wonder, Tatiana, do we need some kind of protective measure also in the area of climate finance, because finance is one of the most mobile sources of production, if we can call it that, globally. It's quite easy for companies to go outside of Europe, the big ones, and finance somewhere else. Do we also need to think about some kind of a carbon border mechanism on capital and not just on goods?
Good point.
Thank you for the question. I was actually first going to react to what Luis said. I realize the temptation with the single market for capital is to say, yes, of course, it depends on everything else, and it just follows on from the integrated market on goods and services. And yes, let's harmonize labor laws, let's harmonize company laws, let's harmonize taxation laws. That's absolutely right. I would not disagree with that. The problem is that we would then lack focus in our work. We cannot, harmonize all of the national laws and, only then hope that CMU would fall into place. I think all of these are very difficult topics, which require a lot of discussions with capitals, and these discussions are very difficult. I was part of the discussions on insolvency laws harmonization in Council. I can tell you in 2 years, we haven't even reached an agreement in Council. While on all other financial files, or most of them, we typically reach an agreement in Council, 9 months time. So that shows how complicated it is. Tax law, same, member states claim competence. We need then common realization from member states and agreement from member states that there's something that shall be done at EU level. Without that, we cannot advance. So I cannot agree more with you, but simply, I'm afraid if we decide to define the perimeter so broad as that, we would never achieve anything. So we need focus and we need support from capital. To your point, Michaela, on the green financing, it's a very tricky area, right? Because finance is always seen as a facilitator, right? It facilitates. It doesn't create on its own, right? But what it does, it can finance what is strategically important, what is strategically relevant for the EU. And this is how we were working with our rules around green finance, rather than saying you have to invest in this or you have to invest in that. Because, of course, this would be very dirigist, and Latvia, I think, is among those member states who knows quite well what it means to be part of a planned economy. I don't think we need to go back there. But I think what is important for financing is to make sure that all those projects of strategic importance where you can make a difference when it comes to climate change, when it comes to reduction of emissions, that those projects are clearly identified as such, and there is no greenwashing. So I think this is the biggest challenge. I think there is a lot of desire from investors, institutional investors, retail investors. Retail investors really, really care about these things. But then what can happen, and what happens a lot, is that a lot of this money go into projects that are green only on paper. So I think I see more the role of financing as to make sure that, the pipeline from those who provide financing to those who use that financing works properly, that the right types of projects are identified, that they deliver on what they claim, so on their ESG claims, as we would argue, rather than saying, well, actually, you have to invest only in this project, and you have to invest, this is the minimum amount you have to invest, and you cannot do without. It needs to be a market-driven process. But for investors to make informed decisions, they actually need information. And this is how we structured our taxonomy rules. This is how we structured our fiduciary duty rules, sustainability reporting, around those principles. We need clear labels for products, for information. We need adequate disclosures. So those who design financial products to channel financing can do so in full knowledge of what investors are going to invest in, so that investors do not get tricked into investing into something which is ultimately not green. So let's be careful about not over-regulating, because and here I would if you ask me the question that you asked to Carol, I would have quoted what Ronald Reagan said when he was the president of the United States. And as you might know, his famous phrase was, if it moves, tax it. If it keeps moving, regulate it. And then if it stops moving, subsidize it. So I really hope that in Europe, we're not going to follow this model.
We have a panel on supervision later on, and I think we can have a bit of an argument about the supervisory efforts in some of these areas and how this is impacting. Personally, I think a bit of a hard hand here could be actually quite important for the climate transition, but I'll let the Vice President react.
No, it's about the ambition of the projects, and that if we are too ambitious, we are going to get nothing. Well, remember one thing, 30 years ago, the single currency was a dream, and it became a reality. Sometimes, you have to set up, targets that are not easy, that seem very difficult, but at the end of the day, that imply a clear step forward, like the single currency. And let me say something additional. My concern with respect to, focusing in a partial equilibrium approach with respect to the capital market union, instead of having, a general equilibrium approach, including other aspects, is that perhaps we will continue, in a sort of a stalemate situation as the one that we have now. A lot of talk about supervisors, insolvency rules, taxation, and these kind of things. And at the end of the day, the delivery will be quite limited.
And I think this is a very strong point. And if we go back in the European history, the creation of the single market, and then with the euro, it was clearly the combination of the two that could unlock a lot of potential and also offer important stability.
And if you allow me, because you said something that is quite clear, there are geopolitical risks, a lot of uncertainty. And perhaps, this difficult environment is going to be, the real, trigger of the changes that we are going to need in the future. Because we will realize that, there is only one way. And the way forward is only integration, additional integration.
Can I just say a few words? Because I actually agree with everything that Luis just said. I fully agree. But the difference with the euro is that at the time, the heads of state got together and said, there should be a euro, right? And then they did it. They get on and did it. The problem that we have with the Capital Markets Union, there's a lot of talk, as you said. Heads of state meet and talk about the importance and relevance and time being lost and all of that. They all agree on that. They agree on the importance element. They fail to agree on what concretely should be done. We fail commitments at the highest level on let's actually work on common tax laws, or let's work on common rules for, labor laws or company laws, because this is what matters to companies. And I fully agree that CMU would follow on. But we lack commitment, and without this commitment, there will be just talk. That's the difference with the euro, when heads of states actually got an agreement amongst themselves, and then just technical levels carried this out.
Well, if you allow me, I was involved in the negotiations for the launching of the euro, and I can assure you that it was not easy.
I remember studying those negotiations, and I confirm that fact. But I think when I look at the questions here, there are a couple of very interesting questions which turn around exactly. We have the excitement now of the Draghi report. You mentioned it in your speech. And then someone here rightly points out that almost 10 years ago, so I think it was in the summer of 2015, we had the 5 Presidents report. With a lot of excitement about that as well. Tatiana, you'll probably shoot me for saying this, so I'm happy you're on video. But not all that much happened after the 5 Presidents report. You'll probably argue that lots of things happened, but not enough happened, I will argue. And I think when we look today, there are a couple of questions here which also mention some very scary things. Can the current EU survive with these super low growth levels? Are we facing a potentially existential crisis? I have a question in here. Should we be worried about Frexit, Dexit, all of these things? Do we really have what it takes to move ahead? Now, I want to be super optimistic here because I'm a big believer. I always think that I remember during the European debt crisis, somebody shouted at me in the trading room, either this is fixed in 3 weeks or everything blows up. Well, not everything is fixed. nothing has blown up in a major way, and here we are many, many years later. So I have a great belief in the European resilience, but I think this slow growth is something we have to be quite frightened of. Especially, you mentioned many of the geopolitical risks we see around us. We see political risks within our own countries. Many of them can be linked back to the slow growth. You mentioned the structural factors which don't give us that much optimism that we're going to suddenly break out and have a great growth bonanza here. What can we do about this situation? Can we have some optimism here? Do you think, Rim, that the new Draghi report is going to be the wake-up call that we need?
We always have to have optimism to continue moving. Hope it's a part of our DNA, and I think we have survived in fact, in many crises. I mean, we followed since 2007 the financial crisis, the pandemic crisis, the war, the conflicts, and all of this. So I'm sure that in challenges, there are always opportunities. So I think we need to rethink a bit growth and move into different matrix, which are well-being matrix that are involving the individuals per se. So we need to rethink our GDP growth matrix, and I think there has been many initiatives that are trying really to do this thinking. It's very difficult. I mean, it's since 10 years practically with the Stiglitz report in the time of, and then of course we didn't move forward with it. I think we need to understand that probably our models cannot be only focused on shareholder value model. We need to open a little bit more into stakeholder value model and in a broader sense, and then try really to integrate this ESG. ESG is not only a matrix that we like to calculate because it's a compliance matrix. It should be part of a changing business model, I would call it, and then try really to think broader a little bit more. So then we exit, I would say, the vertical thinking that we've been into and go into a little bit more lateral, creative thinking that will allow us to find solutions in situations that probably if we keep focused on a certain problem, it's very difficult to find a solution because there is no solution. Especially when the risk and uncertainty is heightened every day. So my second point I want to make is that taking, for example, these transitions, all transitions there are opportunities. But then we need to seize opportunities and try also, eventually, Europe has been taking the lead in certain, rhetorically, yes, but then if I look at the data of China and US, it's much more investment they're doing on the green economies and digital economies. So probably try to build on examples like the work of the EIB. EIB is a green bank, is a real green bank with a green bond issued and so on and so forth. Probably we need to enlarge all of this to a certain way and try really to see to what extent, for example, all the banks in Europe can push this green asset ratio a bit further. Also trying really to benefit from the digital transition, to increase productivity, and to increase competitiveness of the European economy. So this is all possible. There are scenarios. But then also we need to prepare for the worst case scenario and avert it. So not to be afraid of it, but try to avert it.
But I think you mentioned a super important point there. So first of all, let me start by saying that the European banks are embracing the green transition. And as you know, the European banks were very engaged in these areas. So it's a huge topic for us. And one of our biggest concerns is that the green transition does not happen over in the real economy, because you can have very nice green European banks financing a really small green economy. So what we want to see is that green economy growing in a very big way. So I think this is a big thing for me.
Can I add one point? I agree with you absolutely, but then banks can also promote this green thinking with their clients. And
Absolutely.
I think this is important, especially for the SMEs. So a role of banks to ensure that SMEs that are also embracing this green transition with incentives. and the right incentives.
And this is something that we very much do. And, you know, I see it on a day-to-day basis in our work. When we have, for example, a government subsidy scheme, you know, it can be something very simple, just helping homeowners getting better access to isolating their homes. We can have it as a business opportunity also with the homeowners. We can advise them, and you can see how everything can work together. So I think this is very important, and likewise with the companies. If you look inside the European banks today, you will see that many of the banks have teams that are specializing in different sectors, specializing in the technologies. Now, I'm not an engineer, and I'm afraid of talking about technologies live on stage, because when I get home, they will tell me I got it all wrong about the details of the technologies, so I won't go there. But they really work with our clients to discuss these various issues and to understand it. So I think the European banks are embracing it as a business opportunity in a very big way. But I think you mentioned something very important, where I think sometimes we struggle, and it was part of the discussion about the boats in the harbor, right? Because we have to protect ourselves from all the risks you mentioned, but then we also have to be able to take risk. And I think this is where, you know, in Europe today, yes, we have to be safe, but we cannot be 100% safe, because then we stay in the harbor. And I don't know what happens to the boat when it stays in the harbor for too long. Probably it gets barnacles and sinks in the end. But I think, you know, this is really, I think, is a difficult thing for us. How can we change this mindset?
I wouldn't say we have to protect from the risk. We have to take risk. We have to face the risk and to have to manage the risk.
Exactly.
So this is what our mentality is. So our mentality cannot just say, I don't want to take risk because risk will take me to, for example, okay, with the boat I go to a storm. There is a storm, but if I am prepared for a storm, I'm not afraid to go, you know, and deal with the storm. So in reality, we need to prepare our mind to be able to face the risk, and we cannot escape as humanity nowadays to develop mental skills to face further risk. So the risk is going up. I mean, in the Second World War, I think we had a good history to learn from. And nowadays, all these risks are coming from different perspectives. It's impacting our population. We see it in the reports every day, practically, in terms also of the mental health of the population. So practically, we need to prepare ourselves to face higher risk scenarios. And we cannot just be afraid of them, but rather face them, manage them with data. We have the data, we have the scenarios, we have the models, and we just need to sit and work on them with help of models that are devised of artificial intelligence. But we need to prepare for the systems very well, not only in terms of the banking sector, but also in the real economy you mentioned. And this is not real economy and banking sector, so there is no a distance. So the distance has to be a bit closer. Yes, I know about the asymmetry of information, but asymmetry of information in an era of enhanced data and availability of data and access to data, and also management of the data, we need to rethink it as well. So that's why I think we need to get a little bit closer and understand that all this heightened uncertainty and risk, we need to face it together, hand in hand.
So I agree 100% with you on this. I think we're getting closer and closer to the coffee break, so I want to start rounding off the panel here. And one of the things that I often think about is, you know, we have many of these events, we discuss all of these things, but I always like to think about something tangible. So I was reading through the Draghi report, and I read the long version as well. And one thing I thought was super interesting, so I'm going to take this from my wish list for Christmas, is I like the idea of having maybe thinking about doing something specifically for the cross-border banks, you know, starting in a smaller area and creating more of a single jurisdiction for the cross-border banks. I thought that's something nice. It shouldn't be too difficult to do at the political level, because we all understand, you know, my real dream is to have fiscal union, Eurobonds, and the full Monty, but I know I may be an old lady before Christmas gets that far. But I think this was something really nice and tangible. And I wonder if I could ask each of you to say something very tangible. And I have a twin tangible question for you, because there's one here that would like to know exactly where we can find the Financial Market Integration Report. I believe it's on your website. So if you could just confirm that this is indeed the case. Then maybe what I'll do is I'll start with you, Tatiana. What is your wish for like the one tangible thing that we could get over the next year, which you think could be realized?
Well, I'm not sure I have an answer to that, but there's one thing I really want to do, because I think what we lack in Europe is a scale. So I think we really need to go into volume. So how can we raise the size of capital markets? And there is one simple remedy, well, maybe not quite simple, but there is one remedy, and that's pensions. And I think, Rin, you did mention the social dimension, the intergenerational and anything aging dimension. And I think that has the benefit of channeling a lot of savings into capital markets, basically increasing the scale of capital markets, and at the same time, potentially tackling the issue of insufficient retirement income for people. So personally, I would really work on auto enrollments and products that would, at a reasonable lower cost, can be invested in through the employer scheme. So that would be one thing I would be working on. Not easy, for sure, not easy. Pensions, never easy. But I think if there is one thing that would have a tangible effect, we will have masses of additional savings flowing into capital markets. We've seen it with the Netherlands. We've seen it with other markets where you have well-developed pension markets. You also have quite thriving capital markets.
And Tatiana, I'm tempted to ask you in that context, do we need to have that along with securitization?
I think it's a different debate. Securitization is really a means for banks to pass on risk and to offload loans from their balance sheet. It's a different thing. Well, I don't think securitization are instruments for retail investors.
I'm going to disagree with you on that, but it probably shows my Danish bias, where we have a huge mortgage market and we have a huge pension saving industry. So I'm tempted to see the two coming a little bit hand in hand, with a supply and a demand story filling together. But we can pick up on this discussion, because of course I'm opening a bit of can of worms here. So I'll stick to timing, and I'll go to you next, Carol, and ask you what's your one thing you think we can get and which could happen?
What we need to do urgently is to pool or fund markets in Europe to really incentivize retail households, savers, to invest in the markets. Today, our market is hopelessly fragmented. We have 4 or 5 times as many funds as the United States, for a cost which is also 4 times higher. So a consumer is not stupid. They see the funds are far too expensive, so they don't invest in funds. If we had an initiative by the industry to say we do everything to pool funds, which is, by the way, the examples of Sweden and Denmark, they have very pooled fund markets. By an attitude and a combination between the markets and the supervisors, now we'll make sure we have a few single big funds where you have lower cost, good asset allocation, better returns to, convince savers to invest into this. This could make a big difference. So we have it at the level of some member states, but we don't have it at the level of the EU. And that could be a big change.
And Rim, your wish? Which you think can come true? This is important.
Finish the unfinished business of the banking union, EDIS. So I'm not going to
do you think we can have that in a year?
We need to push for it. I don't want to commit.
It's good to have ambitious wishing. Yes. I like that. That's good. And Vice President, what would be your...
Well, I think that there is not a magic solution for anything. Yeah? I think that from a journalistic standpoint, your question is very interesting, but I think that is a little bit, let's say, far-fetched. Huh? I would say I think that it would be important. It's not easy. It's about mutualization of risk and the reduction of risk. But it is, I think that to complete the banking union for me could be very, very, very relevant. I don't know whether this is going to happen over the next year, But, you know, we have to answer to your question that, well, in 1 year time, well, in 1 year, a lot of things might happen.
Well, I'm going to cross my fingers. I'm going to keep a bit of optimism
Okay,
here, because I
sure.
think at the end of the day, if we don't have some steps in a year, I'm going to become a bit more nervous. And with that, I would like to ask everyone to thank the panel, and also thank you for everyone who asked the very good questions. Thank you for that, everyone.
Thank you very much.
Thank you.
Thank you very much.
Thank you.
It has been a pleasure.
Thank you very much, and thank you very much, Mikala. You certainly succeeded, at least you succeeded at more things than that, but at least at one thing that my communications team is always telling me, that in a good panel you should have some disagreement. So there was some disagreement. I think that's good and that's healthy. So now we all have to venture out of the safe harbor of this auditorium into the coffee break, but please be back at 12:30 sharp. Thank you. Thank you. So thank you for coming back on time. So we have a second panel discussion, zooming in now on the banking sector. And here I have to tell you also one thing. A while ago, some weeks ago, actually, also a true story, a friend of mine lamented that, now people go from the private sector into the safe harbor of the public sector. So they go to work for the central bank or for the Ministry of Finance, etc. Well, here I have one person today who has done the opposite, who has ventured out of the relatively safe harbor of the ECB into the private sector, been now a couple of years chief Europe economist at Morgan Stanley. And yesterday he very humbly confessed to me that it is his first time ever in Riga. So let's give a very warm welcome to Jens Eisenschmidt. Over to you.
Yes, hello from my side, and thank you very much for the kind introduction. I should maybe add that it's sort of going in circles. So I worked in the private sector before I went to the ECB. And I so I joined the ECB actually in September 2007. That was 1 month after the financial crisis started, so it wasn't me. But it was actually a very good experience, and it's great to be now on the other side, and it's a fantastic thing to be here in Riga and to be moderating, be invited to moderate that panel. And let me, without much further ado, introduce our great panelists. So we have first here the acting current SSM chair, Claudia Buch. Since January 24, she's been a chair and was previously the deputy governor of Bundesbank, has also a significant academic career before that time as a member of the German Council of Economic Experts. So let me welcome Claudia Buch here on stage. Then, yeah, please come up. And then, just to give everybody a little bit of the introduction, then we have the governor of the Central Bank of Lithuania, Governor Simkus. Can I please also ask you to join? We have another representative of the private sector here, Gonzalo Gazo, Senior Director of the Prudential Policy and Supervision Unit at the European Banking Federation. Can you please also join us? And last but not least, our host here, the Governor of the Bank of Latvia, Mārtiņš Kazāks, who I think will also give us some introductory remarks. Thank you very much.
Yeah. Hello again. It's nice to be a host because you get more airtime, okay? More chances to speak. But to be serious, before we kick off the discussion, I'm going to go through some of the slides just to point to some of the issues. How do I read the current situation, not only in the Baltics, but in Europe overall? We have one currency, but we have, by and large, unfortunately, 20 separate and fragmented financial markets. And these markets are very much dominated by banks. In the US, if we compare to the US, a bigger role is for other types of financial institutions. So in terms of the fleet that I mentioned in my introductory remarks, the US fleet is much more diverse. Our fleet is very much dominated only by one type of ships or boats. This fragmentation of European financial markets has a couple of, in my view, very important characteristics. Point one, what we see, we do not see one homogeneous banking sector or market. What we see 20 different banking markets with very different characteristics. And here you see lending volumes in the case of Latvia and Baltics overall, I would mention. This situation is quite similar in all three Baltic countries, especially Latvia and Lithuania. And Gediminas later on, of course, will share the Lithuanian perspective on this. We see that in terms of the loan book to households and non-financial corporations, there is very little volume compared to other euro area countries. If we take a look at the lending rates, we see that lending rates vary significantly. And the three largest bars are for the three Baltic economies. Latvia is the dark red. We see that we have in the Baltics a situation where the lending rates are the highest in euro area, and we see that NPLs, or non-performing loans, are one of the lowest in euro area. So that is what is the perspective of a customer. And not that much lending, and if there is lending, it is a quite expensive lending. Then, of course, it has an implication also for monetary policy transmission. So the direct business of the central bank and the efficacy of monetary policy to slow down growth and slow down inflation, or to support growth. We see from the charts here that the current episode, to the very left, what we can see, the red line is the very recent tightening cycle. The shaded area is the past tightening cycles. We've seen that this current tightening cycle has been very sharp. And the second panel to the left also shows that it has been more effective to drive down inflation than the past experience as a counterfactual would show. So this red dashed line. These are the ECB estimates. And the current tightening cycle has been very successful in terms of the cost of tightening. The sacrifice ratio, or to put it simply, the cost to the labor market in terms of unemployment increase, has been significantly lower than in the past few tightening cycles. So monetary policy transmission overall has been very effective, but it has been very different across the markets. And this is what we can see here. This is the estimate by Bank of Latvia together with the OECD colleagues. To the left, we can see long-run pass-through in euro area to bank lending rates from monetary policy tightening. And to the right, we can see the long-run pass-through to bank deposit rates. What we see that the pass-through the deposit rates is much lower. Pass-through to the lending rates, in fact, overall, is quite high, quite close to 1. Okay? But this is a long-run pass-through, estimated on data from 2007 to 2023. The transmission, of course, differs from country to country. And just to give you an example of Latvia, or the Baltics for that matter as well, and Netherlands, the stories are very different. In the Baltics, all loans are priced, by and large all loans. More than 90% of loans are priced with floating rates to the Euribor. Okay? So the transmission is almost instantaneous to the lending rates. Not the case in the Dutch case, okay? Where the rates are much slower to adjust, there's more fixed rates. So by and large, perhaps Netherlands will never see in their pricing the peak of the interest rates. Okay, so the differences are there, and they are on both sides. Okay, they are both on the lending rates, but also on the part of deposit rates. We already mentioned today that progress towards more integrated euro area in the last decade has been very small. In fact, I would say it has been disappointing. If you take a look at the chart to the left, then what do we see there? Banks, okay, monetary financial institutions, mainly banks, of course, dominating the market, lending to non-monetary financial institutions. The dark part of the bar is lending to the domestic counterparts. The gray part of the bar is other counterparts, so from other jurisdictions of the euro area. So by and large, the increase has been tiny, and the banks are still active in their own markets, not cross-border activities. If one takes a look at the debt securities, in terms of debt securities, the situation is somewhat better, but there is still a very strong home bias. And in fact, if we take a look at the situation in 2023 compared to 1997, so just before the inception of the euro, the numbers are even lower than that. There's been some recovery post-global financial crisis. But in this respect, European economy and financial markets are even less integrated than we were more than 20 years ago. Okay? We already heard Luis de Guindos today referring to the ECB study, and this is part of the ECB data. What we see here is the composite financial integration indicator. That's a complex measure of bond markets, equity markets, and interbank markets as such. We can see that overall integration, again, is below those levels prior to the global financial crisis. Okay? We are having financial markets that are fragmented along national borders. And the outcome of this is very much the outcome, what I would say, a bad equilibrium. Okay? Fragmentation may lead to different bad equilibria. One possibility, and I'm just going to mention two. One is the limited competition outcome, when we have more stringent lending conditions, unattractive lending rates, limited access to financing, so there is not enough competition. And that is very much how perhaps I would view the Latvian and the Baltic situation, but it's very much the same story in Eastern and Central Europe as such. So we are not unique here. Point two, sovereign bank nexus. Okay. If we have very strong home bias, and we see that it has somewhat strengthened prior to compared to the 1990s, then of course the crisis has more amplification, okay, through the banking system, which is the main lender to the economy. And we also have higher fiscal vulnerabilities. So either the economies are underbanked or they are more prone to various types of crises. Okay. You may say, you know, this is only bad news so far. Okay, where does it lead to? And that's the last slide. Okay. In short, fragmentation leads to suboptimal outcomes, bad equilibria that reduces growth and well-being of our societies. So then the question is, how come? If you take a look at the return on equity for banks, okay, you may say this is only 2023. True. Okay, we may look at somewhat longer perspective. But if the profitability is so high, how come nobody is actively entering these markets? Okay? And that is, in a way, the question that I, from my side, would like to pose to this panel is, what holds the market forces from finding a better equilibrium? Thank you.
Yeah, thank you very much, Governor Kazāks. So I think the backdrop really is just to establish a couple of key facts. I think it has been mentioned several times now. We face a predominantly bank-based transmission system. And then that means essentially capital allocation, at least in significant parts, has to run through banks. And that's what the panel here mainly is about. trying to get a sense of where we think banks are. I mean, just to sort of give you some backdrops, also to make some advertisement for our own work. So we have been looking, for instance, at the needed capital allocation implied by European legislation related to the Green Deal, related to energy transition, and that are numbers which are in excess of 3 trillion. Of course, the time period here is also maybe a decade, but still it means that that's not something that can be financed out of public purses. It would have to come through the private sector, and here again we are back to the banks. Similarly, you have a discussion right now in the public domain about the Draghi report. We will probably touch base on this report also here in the panel that says that, okay, we are maybe at 22% of investment GDP in the aggregate level at the euro area, but we need to get to 27, which essentially means another 800 billion, 700 to 800 billion per year in terms of additional investment spending, predominantly, again, intermediated to the private sector balance sheets. And again, banks come to mind. So in a way, that's the backdrop here. And let me maybe give each of the panelists some time to offer his or her perspective. And let me start with Chair Bourg. So maybe let's start even with a positive message, because I think you have good reasons to give positive messages. You're almost a year into your new role as SSM chair. First, can you give us your first assessment? What did you find? How does it work? What works well? What do you think are the challenges ahead? And then, once through with that, what's your view on fragmentation, and how does that affect bank lending in the euro area?
Thank you. Thank you very much for the question. But first of all, I have to also thank the organizers for bringing me here. So I'm really glad to be here and to join the discussion. And actually, the question, I thought it was an excellent opening to our discussion, the presentation by the governor, and he posed really difficult questions. So why is it that we see not more cross-border banking activity? Why do we also see, I think this is the underlying issue you mentioned, very different structures of national banking systems across the euro area. And I don't know, not everybody can see it, but here actually the clock kept counting upwards. So it's a difficult question. So it was, if we were given more time actually to answer that question, I'm not sure whether we will fully manage. But let me talk about my role, the role of the SSM and the banking union. And I think one important thing to bear in mind is actually, why did we put into place the banking union, the SSM, in the first place? It was really because we were coming, in some sense, out of a period of rapid financial integration. So there was, in fact, a lot of cross-border capital flows prior to the global financial crisis. And it was partly part of the problem, because we knew with hindsight that these capital flows were not really sustainable. So that's why there was a big adjustment. In particular, I think in this region, I mean, this needs to be stressed, there was a big retrenchment initially in terms of interbank lending, so huge a sudden stop of capital inflows, requiring also very strong adjustment in the real economy. But of course, the foreign banks, and I think you mentioned this, stayed in the region. So I think this was a very important. This is very important to bear in mind. So in that sense, it's a little bit difficult to compare the numbers prior to the global financial crisis, the European sovereign debt crisis, to the numbers now, because we need to look into other indicators as well. We need to look at into the resilience of the financial system. So this is basically why the banking union was put into place, to make sure that banking systems are resilient, the same lending standards are applied, that we look at banks through the same lenses, that we apply the same standards, and that we can benchmark across countries. And that's actually extremely useful, in particular, I would say, also for smaller countries where you may have very specific banks that you can't easily compare within the country. So we can do all these things. And you asked me, so what did I experience coming to the SSM? I think really my impression, even before and now even more, is that the system system is working really well. So we have a common approach to supervision. Whenever I'm also doing my country visit here, and then later on in Lithuania, whenever I do my country visits, I get very positive feedback also from my colleagues as regards the cooperation with the national supervisors. So I think we've really put into place a very strong system that is working well. And we actually this year we have the integration year, so maybe it's also related to the topic of this panel, the integration year, but here meaning the integration of the SSM. But then, of course, lots of things have changed around us. So we live in a very different geopolitical risk environment, and I think also these risks are not going to disappear anytime soon. So we have to be aware, the banks have to be aware of the resulting risks, and also supervisors have to be aware of the resulting risks and make sure that the banks have good strategies in place to deal with these risks and also reduce their exposure. Then we have digitalization, again, very interesting experiences across the region, which of course can be business opportunities for the banks when they team up with fintech providers. So this can really further improve the provision of financial services. But digitalization also implies risks of cyber attacks, risks of many different sorts. So, and again, we need to make sure that we can address all these risks properly. Now, of course, we, as everybody else, we have limited resources, and we're also aware of the fact that despite all the progress that I mentioned, we've built up a relatively complex system, how we do supervision. Those of you closer to the banks here in this room are familiar with the SREP, the supervisory review and evaluation process. So we also considered what do we have to do in order to adapt to the new environment, and we've just this summer decided on a big reform on our internal processes to make our supervision even more efficient, effective, and also more intrusive. So giving also clearer guidance to the banks as to where do we see deficiencies, what are the root causes, and where do we expect remediation, and then we will also follow up upon our recommendations in case we don't see findings being remediated. So this is basically where I see the SSM, how the environment has changed, what we have achieved, what we can do. Let me just say very few words, and I will be quick on how do we see the banking sector, because that is of course our main role to look at the banks, how resilient they are, and overall the banking sector in Europe is resilient, is definitely more resilient than it used to be at the beginning of the banking union. So risks have been reduced, capital levels have been strengthened, in particular in this region. I mean, this is always for a supervisor, it's always good to see that levels of capital and also profitability are high. But as I've said, there's no time for complacency. So we do have new risks which are not always well reflected in banks' internal model and past time series. There's lots of uncertainty. So I alluded to the geopolitical risks. They're often not priced on financial markets, and this is a problem because we all rely on the market data that we get, but if the market data don't take political risk into account sufficiently, then there's an issue, and we have to think about other ways of capturing these risks and uncertainty. And so this is why, and I can only reinforce that message, resilience is needed both financially, of course, this is about capital and liquidity, but also operationally. And I think this is really important when it comes to cyber risks and also physical risks that might affect the banks. This is why we conducted the cyber resilience stress test this year. And we're working very closely with the banks to remediate findings and also provide best practices as to what can be done. And I think this resilience. So the title of this panel, of the whole conference, is financing a better future. And of course, I mean, this is the main role that also banks have for the real economy. And I think the more resilient they are, the better they are prepared also for future contingencies. The better they can provide this role. Let me stop here, and I'm sure we'll go into more detail later on.
Well, thank you very much. There were already several points on which we can actually later come back to. Also, I have already seen questions keep rolling in, please. post your questions. I will later aggregate them and open up essentially for the round. But let's, for the moment, continue maybe in the region. Governor Simkus, what are the issues you are seeing in Lithuania? What is your take on credit dynamics in your country? Just to provide the other perspective, I imagine this is similar to what we have seen just on the slides by Governor Kazāks, but just to sort of complete the picture from your perspective here.
Well, so first of all, thanks for inviting into this very interesting and I think important conference. And yes, developments are similar, but I will provide my take, my view onto the things. Mārtiņš, I think you found very good allegory how to describe the system, the banking in our countries with harbors and ships. But I still find relevant the other allegory of the glass half full or half empty. So if it is, and people say half full, half empty, full, empty. But it's a matter, as a fact of life, there's half of a glass. And all the other words just describe how you feel about it. So that's how I feel when I consider the banking in the Baltics or Lithuania, mixed feelings. So, I mean, I was thinking how to organize my thoughts, and I was thinking in a way that why not to start about like just saying a simple fact of life that modern economy is dysfunctional without the banking and capital market. And you, Claudia, mentioned the banking union. Very rightly, it creates resilience, looking through the same lens and so setting the same standards. But it's about being more risk prudent in the single market. When we consider capital market union, it's about the accessibility of capital, of finance in capital markets or money markets. Why we are considering this? Because we are not happy. So these markets or banking in the in Europe, it's about banking, finance is about banking. So we are not probably that happy. Something is missing. And I think that we shouldn't. Yes, banking is a private business, but in a way it's private as railway companies or utility companies or electricity companies. It's private, but at the same time, it plays a very important, distinct, crucial role in our economy, and therefore we should not be looking into the sector the same as into any other economic sectors, textile industry, I don't know, any other manufacturing or barber shop or something like this. It's very special. Then, Mārtiņš was showing really important slides, but as what regards Lithuanian banking system, it's super effective. It's one of the most effective banking systems in the European Union. Quality, loan quality is one of the best in the European Union. It's very well capitalized, one of the best capitalized banking system in the Union, one of the best liquidity, and of course one of the most profitable banking systems in the European Union, even after the windfall tax was introduced and accounted. So from the prudential point of view, from the supervisor's point of view, and Bank of Lithuania is also a supervisor, we are happy. This is one of the most prudent banking systems. But let me get back to the, so is the glass half full, or have I started with this allegory of half full, half empty glass? Somehow, having such a strong banking system, actually loans are also growing in Lithuania. 11% to private companies on a yearly term, and it's far more than in the European Union average and more than in the Baltic neighbors. But why the society is not happy about this? We have constant complaints and dissatisfaction, both by households and companies. And I think an important statement or was said by Professor Rim Ayadi, that as this is such an important, crucial sector, banking, it should not be considered only from the shareholders' perspective or maximizing value for shareholders, but also for stakeholders. And the stakeholders are society as such. So, loan NPL ratio, one of the best loan quality is good from banking perspective. But in Lithuania, this also means that we have one of the highest loan rejections ratio in the EU, actually the highest, 4 times more than the EU average. When we consider the efficiency, yes, banks are very efficient, but we have one of the lowest approachability to ATMs machines. It improved because of the certain regulation, and we have constant closure of the branches across the country. Sound lending also converts into one of the highest collateral requirements for business lending, far beyond than the EU average, and et cetera, et cetera. And how come we have this situation? Because we have very sound banking system. And I think we in the Baltics, we have the same bank names, Swedbank, SEB, and all the others. So bank names are the same. So banks, and actually banks are the same as 15 or 20 years ago. But banking has changed. So the way the banking is done, we see that banks became more risk-averse. We see that banking models of banks they converged, in fact. They provide more or less or similar products. They compete for similar clients. So we have increased number of institutions in the country. But at the same time, we have banking system where banks having capital, liquidity, know-how, so the names have left. And for small institutions, it takes time to grow and to compete. So what I'm saying is that it's not about only having a number of banks, but it's also about banking and how it's created and how it's done. So, and I want to finish this first introduction with again, repeating the professor's idea. Because of the importance of the sector, and I think it's also because of the situations that could be different in each single country, but Baltics have their own very special situation. We are in a position where it's not only about banks' shareholders' value maximization, but we should also be watching and keeping an eye on the stakeholders' value enhancing. And this comes with some additional regulations that we have in the Baltics.
So thank you very much. I think that was clear in terms of highlighting the special role that banks have always played in our societies, and it's a particular, of course, European model. Maybe let me turn to the private sector here, before then circling back on a discussion on solutions, and maybe just simply ask the question to you, Gonzalo Gazos, as a representative of the EBF, why do EU, Euro area banks do not extend their business more actively across borders, which we have seen here seemingly? Why is the, literal $100 bill at the pavement with the close to 20% return on equity in Latvian banks not being taken up by some of your member banks?
That's a very good question. But let me first thank SUERF and the Bank of Latvia for your hospitality. And when Ernest called me to participate in a conference in Latvia about the single market, my memory went back to June of 1990 when I was completing my studies at the University of Madrid in economics. The single market was just an incipient idea, and Latvia was in the middle of the Declaration of Independence. So you will agree with me, a lot of progress has been made, including in the single market since then. But with that positive note, let me, Jens, now refer about the problems of cross-border banking in Europe. And I think we need to have perspective of what happened in this 30-year period of the single market. We can divide it in two parts. the first half from 93 to 2008, there was a lot of cross-border activity, including M&As in Europe, and that was the result, in my view, of three concurrent factors. The first one was technology. We talk about technology these days because digital banking, but there was a real breakthrough of technology and data processing capacity in the 90s, and including also the emergence of online connectivity. That was a game changer. Then the interest rates were high, what makes investments more attractive. And finally, there was an enabling regulatory change that was the single banking license adopted in 93. Then this process came to an end with the great financial crisis in 2008, and since then, the cross-border activity has dried up. And that is, in my view, because banks have been, in the last 15 years, too busy restoring resilience, capital, liquidity, dealing with the euro area crisis and the extended effects in the form of high non-performing loans until the cleanup in 2020. And of course, also the low for long era didn't invite to M&A or cross-border banking. But now I think we are in a moment of change. We might be in the turn of a cycle because the same conditions that triggered all this cross-border activity in the 90s are becoming apparent again. Technology, a regulatory change, and interest rates. Let me start with technology. Digital banking can be a game changer again because the banks that are adopting new technologies faster can take part of the business, and there could be a transfer of business from institutions that are less advanced in technology, and that is happening gradually. Then interest rates are positive again, and hopefully that will be more stable from now on, making investments more attractive. And finally, the question of the regulatory change. This is the most complicated issue because there is a need for a groundbreaking change in regulation that can unleash the potential of bank consolidation in Europe. The same as it happened with the single banking license in the 90s. The crisis management and deposit insurance could be the game changer in the current 20s. And for that to happen, there needs to be an agreement, especially between member states, because we all agree in Europe about that, but then there's need to take it to the decision-making process. And that would probably give way to an unfettered movement of capital and liquidity between banks, and that will propel the cross-border banking in Europe. But there is more to it because regulation has become complex, and there are some elements that are in favor of cross-border banking and some other factors are against. What you count as a banker when you are considering about cross-border banking is, in the first place, if we talk about M&As, it is obvious that if a bank becomes bigger, according to the rules of the game, it might fall into an upper bucket of the GSIB scale, and therefore the bank would need to have an increase of capital requirements of 50 basis points or whatever. But I don't think that's a problem because that can be anticipated and it can be predicted. So if that is part of the business analysis of a potential M&A, what is more worrying is the other part, is the systemic risk buffer that was decided in Europe. It is a gold plating over the international standards, and it can be used at the discretion of member states with no obligation other than letting their decisions known to the ESRB or the European authorities. And that can go up, according to regulation, up to 5%. That is 500 basis points, potentially, of capital requirements. That is a lot. We need to think about that if we are serious about bank consolidation in Europe. And then there are other factors that play in favor. For instance, the single supervisor is an advantage compared to the 90s, and also the fact that the SSM came out with clarity about what happens in case of an acquisition in terms of the recognition of badwill, that is important. Also, the recognition that Pillar 2 shouldn't be increased, at least in the first moment, and also that the banks could maintain the internal models during a reasonable period of time until full convergence. So that is a helpful factor. But at the end, these are only conditions. It is all about business when it comes to take decisions in cross-border banking, and those have to do with business models. The business model has to be credible, and it has to outperform the previous business models of the banks. Then the accomplishment of synergies, that is a very important ingredient of cross-border banking, because there is a huge effort of IT integration, risk management methodologies, and so on that extends over a period of time. And finally, economies of scale have also to justify any cross-border activity. And in the Union, there are many member states that are small and beautiful, but size matters as well, because banking is a business that requires important settlement costs, and you need to put that also in the equation of the business model. And I think that, well, that is a general perspective of the factors that we have in front of us. But again, there is an opportunity now, still in the 20s, if we unlock the possibility of a groundbreaking regulatory change, to see more cross-border activity and the benefits of consolidation.
Thank you very much. So that basically plays the ball back to the public sector here, in the sense of putting the enabling conditions for more integration to happen. Maybe let me then go back to our host, Governor Kazāks. Given what you've heard from all sides, given what your assessment is on the Latvian economy, what would be, in your way, a feasible way to go about banking sector fragmentation? What needs to happen? Where do we can maybe leverage on the Draghi report, where maybe we have to, or can actually leverage on the freedoms that exist within the supervisory community?
I think a couple of kind of comments on my colleagues who spoke earlier. Before I go back to your question, thanks to Gediminas for adding more flesh to the bones. Okay? But let me again come back to the situation. This is not a unique issue only for Latvia, Lithuania. That is a problem to different degree, but still a common problem to the whole of the European financial sector. It is too heavily reliant on the banking sector, and there is somewhat, too much risk avoidance given the past dependencies, the previous crisis, and all these kind of things. But of course, it was a very nice point made by Claudia that at the end of the day, the supervision is exactly the same all across your area. There might be some small differences here or there, but overall, the supervision is by and large the same. Okay? And that means that by and large, very similar playing ground for everybody. And then how have we stuck into this situation, which is suboptimal from the part of the society? Why the society is not benefiting from what we see happening in financial markets to the extent it could. And I think there are a couple of things. One is the perspective, short-term perspective versus long-term perspective. If you are an incumbent and you have some monopoly rights, then of course you would like to preserve those monopoly rights. And then the question is, it is just natural. It's not bad or good. It's just the way it happens because of the nature of the profit maximization. Okay? And then the question is, what are the rules of the game that are set out there? And I think a couple of points then, how do we go about it? I think we very clearly have to realize that it's nice to have, and that's what you mentioned, Gasos, is that scale does matter. Okay? It's nice to have national champions, but if your national champion is a midget globally, it's not going to make much difference in terms of the global competitiveness. So the scale is important. And how do we grow the scale? How do we increase the cross-border business? And that is about hedges and fences along national borders. Okay? So, of course, I would like to be able to find the silver bullet and say, okay, this is what we at the supervision part or central bank part or the national part of the equation will do. And we will, of course, do all these things. We will try to reduce the barriers that are reducing the competition within our economies, that will lower the price and make the services cheaper, that will make the services more flexible and more up-to-date so that the services are not stuck in early 2000s when there clearly was an exaggeration of those cross-border flows because the risks were not taken care of. Okay? But unfortunately, it seems that the first best solution is the European solution. Okay? That the policymakers, when they take decisions with the view of the whole of Europe. Because otherwise, we get into a situation that there's a tendency to take the decisions from the national perspective, and then we lose the potential of single market. And then we're stuck being too small and fragmented. And if we keep choosing a lot of nothing rather than a bit of something, it's going to be just a recipe, for becoming increasingly lagging behind the US or any other competitor. Okay? So my call would be call for action for politicians. Let's choose the European perspective. Let's open the single market and open up the potential of the single market, rather than have our own small cottage industry and vegetable garden, rather than gain on the scale, on the competitiveness, on the price, on the flexibility of services. Because without financing, there is no investment. And the very important thing of the Draghi report is that it kind of puts it into the perspective. If we fail, then that is going to be much more difficult later on. And I fully agree with Gasos. I think this kind of agenda being driven forward that, okay, we need to do this, it will create some results. And I hope that Europe will move forward more decisively without a crisis. There's been lots of improvement after the global financial crisis. But as soon as it seems more or less fine, we seem to have relaxed. Okay? If you take an exam, there is no need to fail it to understand that you need to study for the exam. Okay? We kind of tend to wait for the failure, and then we see that we need to pick up. But, again, and let me conclude with this. I think I fully agree with the perspective that you, Gediminas, painted in terms of the glass half full, half empty, but I think by all means it's half full. Okay? There are lots of low-hanging fruits that we can just reach. Thank you.
Yeah, please. So two-hander.
Wanted to add to what Mārtiņš was saying. We're talking about banking union, but in supervisory perspective and creating like a more single regulatory perspective. But I mean, of course, it's crucial part of the banking business and the way they deal with the supervisors, but it's just half of the story. The other half, and I think even much more complicated and important, it's how you make business and how you deal with the clients, households, and companies. And I think that the infringement for single market, or actually that's why they are fragmented. We are 3 Baltic states, Lithuania, Latvia, Estonia, and they are basically having the same bank names in our countries. And whenever I talk to the banks in Lithuania, how come we have so different banking traditions, numbers, and they say, look, there are so many different regulations. I think we did a good job, you know, like making it more similar in terms of this prudential, supervisory regulation perspective. But what regards the consumer protection, and that's very important. What about the bankruptcy law and its differences? And that's what's important for the banks which make business. So I think this is the area which is still not touched upon. And that is why, you know, if you are in Lithuania, if you are a Lithuanian company, you may have a loan from a bank in Lithuania and you go with the same name in Latvia, and you most likely you don't get the loan there because they don't know you. Simply, we can't get the data from registries. So I jump into the other. We like to talk about so much about digitalization. How are our database? I mean, in a way, they are digitalized, of course. Are they interlinked? Are they interlinked not only in the country but also on the European level? If we really talk about single market, that's the essence. Having data, and there was another point. Maybe I will remember it later.
Governor Kazāks, you had also
just a small advertisement. Okay, we wrote a blog for this conference with some help of our colleagues, to be frank. Okay, but Gediminas and myself, we have a blog on the financial system, and we see an important difference. Financial system, by all means, needs to be safe, without question. If the financial system is not safe, it is not well capitalized, and all that kind of stuff, then it's vulnerable to crisis, and it's just a recipe for disaster. Okay? But in our view, safe is only a subset of healthy, nimble, and agile. Okay? And we need healthy, nimble, and agile financial sector with strong banks, but also with strong other market participants. Like I said in the very morning, you know, we need different types of boats for different types of jobs. Okay? And this is what is especially lagging and lacking in smaller industries, because the scale in those countries, in smaller countries, is much, much smaller, and it's insufficient. So anything that we can do to create something similar along the lines of single market for goods, for services and financial services would be very beneficial.
Maybe this goes, yeah, in your direction.
No, I mean, this is I actually had 3 things on my list, but this is exactly the point. So talking about fragmentation and why do we have these differences in market structures across countries. So I mean, to be very clear, I don't think these differences will disappear even if we do the best policy. So we have different legal origins, we have different preferences. I mean, these are just deep-rooted issues which will not disappear. But having said that, we have very different regulations across countries for areas which are very important for banks. If you just take insolvency-led regulations, so there have been attempts for more harmonization, but it's very different rules that apply across countries. The same with the mortgage market. That's actually a reason also why the responsibility for dealing with systemic risk in the mortgage market is with the national authorities, because we have so many differences in terms of lending standards, lending terms, and so forth. So, I mean, these are all things which, of course, make it difficult, in particular for small countries, for banks to invest in that type of local knowledge. And this is not just about the language; it's just about all the regulations that apply. But I mean, we should invest all of our efforts to get rid of these differences. And CMU could actually be, Capital Markets Union could be an important lever. But we also need to be realistic that not all differences will disappear. Certainly, whatever we can do within supervision is not to stand in the way of more cross-border integration. And so we have clarified indeed how we would treat cross-border mergers, what are the conditions we treat them with the same standards as domestic mergers. So anything we can do to kind of within our remit to make sure that cross-border activity is not hampered, that we certainly do. Second point about complexity. So, I mean, this is, of course, and I alluded to that at the beginning. Yes, the current regulatory framework, supervisory framework is complex. And again, to be realistic, this complexity won't disappear because just modern banking is very complex. And so we need to also make sure that we address the relevant risks. And also partly the complexity is due to exactly the same type of national regulations that then feed their way through consultation processes, negotiations in Brussels. So I think in the end people say, well, we would like to have a less complex framework, but when you look at the process, how we get there, there's just lots of reasons also to some extent protecting maybe national interests, why this complexity then makes it into the framework. Clearly, again, what we can do, we help and support to reduce complexity, and I mentioned that we start with our own internal procedures, how we do supervision, and we have a big reform project underway, which will also, it's being communicated to the bank, so I think this is also well understood. One aspect of complexity and a lot of actually time and energy that goes into is the use of banks' internal models, which of course we fully recognize because it's part of the regulation. But that is, of course, it's also, internal models are not always simple. They're also complex. It takes time. So we also encourage, and we've also have guidance out there of how banks can reduce the complexity of their internal models using less satellite models and so forth, and we certainly support that. So again, everything we can do to reduce complexity, we do. The issue was mentioned about the buffers. Maybe we also come back to the large versus small banks, how we treat them. I actually think the systemic risk buffers are absolutely needed, and this is also related to the discussion that we had here on what are the benefits, but also the cost of banks, of large banks, of complex banks, of systemically important banks for society. I think this was a great lesson learned, an important lesson learned from the financial crisis, that we need higher risk absorbers, buffers in the larger banks because they're just systemically more important. And this is exactly the framework we've put into place. I wouldn't necessarily label it gold plating. It always sounds like it's something, it's a nice to have. I think it's a must have that we have these buffers. And we have, of course, a very a clear and very transparent framework around it. So we also communicate that. So I think it's also, I think for the banks and also for society to which this also ultimately benefits, it's also clear to understand what we do. If I may, just one more word on the implications for society, because I think it's interesting what was mentioned here, the accessibility of finance and lending, and so what happens if banks are regulated more tightly. There was actually a lot of effort going into an assessment of the impact of post-crisis financial sector reforms exactly on that question, because our mandate is to kind of make sure that the banks are stable and resilient. But then, of course, the question is, are there any unintended side effects? And overall, but it would be interesting to see whether you've done similar work also for specific countries. Overall, the message is really a positive one. So yes, the system is more resilient. We have better tools in place to deal also with stress. We haven't spoken about resolution yet, but we have better instruments in place. And there's no negative side effects in terms of less lending to the real economy. It may be that if capital requirements are tightened, then the weaker banks, those that had to struggle in the first place meeting the requirements, that they are kind of retrenching, but then very often stronger banks come in and take up that business. And so overall, it's good in terms of both resilience and also lending. But again, these are a little bit aggregate effects, and of course looking across countries, and it would be interesting to see there might be corners in the system where this does not fully apply, but I think this is important also for the society debate about the reforms that have been implemented.
Yeah, thank you. I mean, I was about to ask you about banking union, but maybe before I do this, because that sort of was the closest that came to my mind, flowing out of your proposal to be a bit more of a single market-minded, or go in that direction of a more single market-minded framework. I found it interesting that you mentioned complexity. And I think this is a very important, and I think totally widely underappreciated issue. I think what happened in our societies is that they have become vastly more complex. I mean, basically meaning that that has a whole host of implications in terms of, for instance, distributional consequences, because only certain parts of society are able to deal with that complexity. But I was wondering, isn't maybe an answer on your end to increase the, say, amount of people that you employ from the other side and vice versa? Basically, meaning as a high risk with all that complexity that we are drifting into a very abstract description of the problem that is seen in a very distinct way from the supervisory side and a completely different way from the banking side. And that leads maybe then to outcomes where basically the regulation becomes complex and difficult. Wouldn't that be, for instance, an answer? I mean, just a very sort of low-level question in terms of, is that maybe an approach to improve, if there's something to be improved, regulatory practice? Essentially increasing the turnover between the two sides, which we probably have more in the US than we have in the euro area.
You mean between supervisors and the industry? Or
yeah,
no?
Exactly.
Okay.
Because ultimately, in the extreme, you risk creating a group of people that judges what another group of people does, without necessarily understanding what that other group of people is doing.
Well, I mean, first of all, there's of course an issue if the transition between supervision and working in the industry is too fast and not sufficiently, regulated. Then of course there can be conflicts of interest. There's a revolving doors issue. So I would be a bit careful to say that we can solve the complexity issue if we just let people rotate a bit more. So, and actually, I mean, what I see, and you asked me about my experience in the SSM, is that it's not that our supervisors are sitting in an ivory tower. In any case, we sit in the Euro tower. It's not made from ivory. But it's not that they sit in an ivory tower and they have no idea what is happening on the ground. So the joint supervisory teams, they are in contact with banks every day. So they know very well what is happening in the banks. And we actually do have also supervisors that have a background in industry. But of course, we need to make sure that they don't work on the let's say the banks in which they've been working previously. So we have to put safeguards into place so that we meet all compliance rules. So I don't think the problem is not that we don't sufficiently understand the other side, and I think this also holds for the banks. I think they also understand what the supervisors are doing, because there's really a very regular exchange. No, so let me give you a very practical example. What we still do in order to improve our efficiency and reduce our complexity, we have a new risk tolerance framework in place. So we give these JSTs that are working very closely with the banks very clear guidance that they can deprioritize the risk that they don't find that relevant for their particular institution, to then have more time to focus on the key areas. We also have a multi-year framework in place so that risk can be looked at over a 3-year time horizon. Again, there might be deeper rooted structural issues that don't change at a quarterly frequency, but there are issues like liquidity which need special attention relatively frequently. So all these tools we have put into place to make sure that our supervision is more efficient, more effective, and we also communicate this very clearly and transparently to the banks.
Thank you. You had a...
If I may come in on this a bit, I think there is a very important element of what you are, Claudia, pointing to, is the evolving nature of the supervision. And one of the reasons is, of course, the economy is changing. Backward-looking versus forward-looking issues. And this has been an important part of supervision as well. So it is a critical element to take note of. And then, if we come back to the issue of the banking sector safety, of course, the risk does not disappear. The risk moves somewhere. Okay? So if there is less risk in the banking sector, so what do the clients do? They move elsewhere. Okay? If they do not get the service, like we heard in the first panel discussion, the fintechs, 30% of the fintechs that are unicorns, or startups, let's be more precise, move to the US. Why? Because they get the service there and the risk moves over there. But similar issues also in Europe. If you take a look at the share of non-banks, it has grown significantly. And so the risk moves away from the banking system, but it moves into the non-bank system. So the complexity of the financial system perhaps could even increase because it is less transparent in that part of the economy. And if something goes wrong, it's much more difficult to identify first and contain the risks second. So the risk, if it's not in one place, it's going to move elsewhere.
Maybe first, Gonzalo, and then we come to you. Yeah.
Oh, yes, I wanted to pick up on the comment of Governor Kazāks, that, and as you mentioned very graphically, that the boats have to go out of the harbor, and that means risk, because there is a tough sea there in front. But regarding risk, you've mentioned it, of all the places where risk can be managed, I think the safest way is in the banking sector, because it has a supervisor. And in other places, there is no supervisor. So let me come up with this outrageous proposal that the supervisors should be happy to accept further risk taken by the banks, because they are the ones who can really monitor that risk. If it goes out of the banking sector, it's even worse.
Yeah, I agree. But of course, the risk should be priced accordingly and managed.
Priced accordingly.
Okay? There is, the safest financial sector is the one that is non-existent, okay? And nobody needs that. So of course, there is always risk, and the risk needs to be priced and managed correctly. Same thing, for instance, in terms of the climate change. We saw in Latvia this year as well, but we saw it also last year, that the insurance sector, there are going to be problems down the road if those risks are not accounted for, they are not priced. And the insurance gap in Europe is only 20% of the climate risk. Only 25% is priced and covered. Okay? And if the climate change, and it looks like that, will produce more storms, more floods, then this gap will increase. And then that will have both financial sector stability issues, but also will spill over to the fiscal part of the stability. So the government's fiscal stability and its ability to help out. Okay? So yes, the risk is there. In certain areas, it's even gone up, like due to geopolitics or due to the climate change. And one has to both price it and manage it. If it just shoved into the corner, it's going to come back.
I had Governor Simkus.
Well, I want to come back to your words, because what you have said is, I would say, let me say, like stereotypical attitude towards supervisor of private sector. You said that those supervisors, we don't understand. And I don't think the supervisors don't understand what private sector is doing or how we are managing the risk. I think we're just taking different perspective onto the same subject, and that's where the difference comes from. Now, the second thing is that yes, regulation is complex. But I remember I started career in 2002, and we were just about to introduce, I don't know, like Basel 1.5 or Basel 2, I don't remember, but the number. But we were still in Basel 1. Banks were providing credit to households and companies, the same as they do now. But now we do implementing Basel 3 with internal credit risk models, everything so complicated and complex. Is it just because regulators wanted this? with complexity. It's just that they somehow came with the idea, let's make things more complex. Not at all. It's industry which wanted to release capital. And they say, look, we could do more business with the same amount of capital. And they started they started complicating things. Of course, regulators reacted. They understood. And I think they contributed positively, not negatively. It's just life, as you, Mārtiņš, have said. It became complex. The way we see towards the same things. But it comes from the point of view of benefit of industry. We have such a derivatives and such a complex derivative instruments which were not existent before. And of course, regulation typically follows. We need to admit that. But it follows in the same way as the complexities in the business itself. And the point I forgot before, but it very well fits here, is that yes, financial industry is complex and therefore it's regulated. But the problematic area is that this regulation also comes with a possibility of national discretions. And I think this is where the problem lies. Overall, the regulation is okay, but then each single country comes up with its own specifics. It becomes a mess. And we have, I want the European Union to be even bigger, but already we have 28, I forgot.
Yeah.
Almost 30 countries in the European Union, right? And if each of them have their own national discretion, yes, then life becomes really complicated and then the market fragmented.
I think we can all agree that we Europeans have a knack of making things that may be inevitably complex, even more complex. And that's probably also to some extent flowing out of the union of these countries that are, have different, as you're also saying, different preferences, different customs. I just remember from my work back at the ECB, the ECB's collateral framework is essentially always best described as a union of all the collateral frameworks that existed before. That's not necessarily an easy framework. So that's fully understood. Let me bring in maybe already at that stage some of the questions, and not necessarily in a very concrete, but more in a overall thrust. I have received here several questions that go in the direction and ask the question, maybe regulation, not necessarily individually, but in the end, in terms of the result, has become too risk averse. I wouldn't know exactly what would be the way to answer that. For instance, of course, at the technical level, you would think that's coming out of risk models, the type of capital that you want given a certain amount of shocks that you see, and that in the end, there are specifications that are industry standard. But could it be that we are in an environment, operating in an environment where basically the totality of the regulation results in something that is too risk averse? That's maybe, probably 3 or 4 questions I got in that direction. Maybe I start with you, Chair Buch, for that one.
So the question whether there's insufficient risk-taking, or
basically whether our overall setup leads to an outcome that's overall too risk-averse. I think that echoes, of course, of some of the remarks made before, also in the panel before.
Yeah. Well, maybe my answer is not surprising. I don't think that's the case. No, it's not that we, as a supervisor, you don't want banks to take risks. It's clear that banks need to stay in your metaphor to leave the harbor and also take risks. But we have of course detailed frameworks because the different risks are different. We have detailed frameworks, methodologies. They're all very transparent of how we're dealing with the specific risks. And I think this is actually, it's very well targeted. It's not to prohibit the risk, but if the banks take risk, then there needs to be, very simply speaking, there needs to be sufficient also buffers in terms of equity capital, so they can, of course, then it's a matter of cost, and this is also what was alluded to in the negotiations around the Basel rules. So how much capital would there be, and how costly, quote unquote, would this be for the banks? But if banks are sufficiently capitalized, they can take not all risks that they want. They also have to have their own risk management. But then the supervisor is not the constraint. But this is really also a question that the banks have to consider. And I would just maybe briefly also come back in that context to the question of whether all risks should be within the banking sector or elsewhere. So there may well be risks that are better. Where there's other actors in the financial system that are better able to bear these risks, in particular when it comes to very long-term projects, to very innovative projects, which are very risky. So then it's really, I mean, it's not really for debt funding, but it's for equity finance. And this is the whole story about capital markets union, that I think it's very complementary to what the banks are doing. It won't squeeze the banks out of the market, but it can complement the very important role of banks that we have. And not everybody in the non-bank financial intermediation sector is an unregulated entity. So we heard about the insurance companies. What is important for me as a prudential supervisor is that we also address potential systemic risks in the NBFI sector, because I don't want, risks to move to other parts of the financial system where there's actors that can better bear them, but then if a stress event occurs, to have them spill back to the banking sector. And many banks are closely related to non-bank financial intermediaries, and we need to make sure that, for instance, liquidity risks spilling back to the banking sector is not an issue. So that's why it's not in our remit. I'm a banking micro supervisor, but of course we also have to have a voice in the discussions on how to regulate non-bank financial intermediaries and the systemic risks there.
Maybe briefly going back, because this is also one of the questions here, how would in your work be, I mean, you have it in the recent speech that the completion of banking union is an important next step. How would that be reflected in your day-to-day work? What would be, from your perspective, the big advantage?
Yeah, no, I mean, this is a very important question. We haven't really started discussing it. So in terms of the metaphor, the glass is half full. It's definitely half full or more than half full for the banking union. So we have the SSM, we have the Single Resolution Board, the Single Resolution Fund, and so we've also a very good framework in place for the resolution of banks and dealing with the gone concern situation, because the role of us is, and this relates to this question on risk taking. Our role is not to fully stabilize the banks so that no crisis can ever occur, but to make sure that if a crisis occurs, is less impactful and it's also less likely. But we cannot rule out that banks fail and that they need to go into resolution or liquidation, and that's why we need the framework there to also deal with these issues. Now the problem is, and this is where the glass is not fully full, is that there's gaps in the current resolution framework, and those gaps have been identified also by the European Commission. There's a crisis management and deposit insurance legislation that has been proposed by the Commission, so it's still under discussion in Brussels, which is closing the specific gaps in the current resolution framework. And we've always been very much promoting and supporting these reforms, because they would really help us also to work more close to improve, of course, also our work when it comes to early intervention powers. But this is now, I mean, let me simplify the discussion. It's let me say it's stuck in Brussels. So there's a council proposal which is not fully taking up all the good issues or the good proposals that have been made. So we have to see how it ends up in the trilogue, and we would certainly hope that the results are closer to the original Commission proposal. And then we have EDIS, European Deposit Insurance, also very controversial discussion, but basically we are operating right now in a regime where we have common supervision, a resolution framework, but national deposit insurance systems in a situation where clearly also risks are migrating across borders. And I think we need also more coherent, consistent European deposit insurance framework. And that would be really my wish for the next legislative term, that this file is also pushed forward. Maybe also to the benefit of the consumers that we've been discussing here. So if I want to have my deposits in a bank in a different country, I also need to be reassured that they will be protected in the same way as in the deposit in the domestic system. So I think this would also promote cross-border banking and cross-border integration if we had a more unified system here.
maybe on this one, because it's also a question received from the audience, going back to the region, there was a question, would it help to have a Baltic, with Lithuania, Latvia, Estonia, a Baltic banking union, just as sort of, if the big European solution takes still more time to arrive, would it in the meantime help to have a regional banking union?
Well, Mārtiņš is sitting here and he wouldn't let me to lie. We are constantly talking what could we do, so to say, to decrease those national discretions. But in our hands are quite limited things because we are institutions, central banks or supervisors, so we can work only in that area. Many of those differences are in the laws. But here I would not support this Baltic banking union thinking. We are in a European Union, we are in Euro area, and we should not fragment the system in which we are. So this is very important. So what if someone will create, I don't know, German and French banking union? Would you like to be in that union, or maybe would it be to stay in Baltic Union? Or if you have Polish, Lithuanian, and then, I don't know, Estonian, Finnish, well, Latvians would go for that or for that. So I think that's dangerous. It's very important. We are Europeans, we are in European Union, we are Euro area countries, and we should strive that we have single market in this jurisdiction, not in like separation.
Yeah. European is speaking. I would join Gediminas on this. And of course, just to add a bit more flesh and some caveat. Of course, we do discuss on a daily basis, also with our Estonian colleague Madis, because financial markets in the Baltics are quite integrated, by and large the same dominating banks and all that kind of stuff. And we work jointly on various topics. And we lend a helping hand to each other. We share ideas. For instance, this same thing that in Latvia was passed last year and most likely to kick in more actively next year, which is the refinancing of mortgage loans. Easing the refinancing process, reducing the barriers so that there is more competition and those with mortgage loans can use the competition to drive down the price. And our estimate that we've done for the Latvian market is for the mortgages outstanding, that would give about 100 million euros just because of this ability to shop around. Okay? So of course we share these ideas, and I understand in Lithuania discussions are also ongoing that something similar would be also passed as a law that reduces or simplifies all these transaction costs that have cemented in the past this bad equilibrium. Okay? But still, I think we of course need pan-European, Euro area perspective. But if somebody is slow to move, it does not mean that we need to create different rules for the Baltics or something like that, but we may see how we can start somewhere, okay? Using the same Euro area rules and implementing them within the countries that are willing, to do this. We've heard in terms of the Capital Markets Union, the French proposition of the coalition of willing. We can certainly say in the banking business as well, the region of willing, or whatever we may call it, so that there is less borders, less fences in terms of the cross-border flow of financial services. I think we need to start somewhere, but I don't think that we should create new rules for new regions or something. Then that's the recipe for disaster and more fragmentation. But let me come back again to one of the elements which I think is also adding to the fragmentation, and that is the issue of long memory. Okay? That people tend to remember bad things, okay? Not good things. okay? And even with the same, exactly the same regulation, there is a tendency, and we see that to some extent also in the Latvian market. The market participants read it in a very different way. It's like they change the glasses, you know. They read it in a much more pessimistic way. And it's like, you know, okay, guys, of course, COVID-19 is no fun. Okay, everybody remembers that. But there is a vaccine, and it's not that deadly anymore. So it does not mean that you have to keep yourself into isolation because 4 years ago there was an outbreak of COVID-19. And same thing in comparison to the past crisis. 2008 was a very bad year for the Baltic economies when we had a massive crash. Okay? But this was a coincidence of very many things that are unlikely to be repeated. One is too much capital inflows without any risk assessment and expectations that income convergence is God's given. It will happen by itself. Productivity will go through the roof. Now we know it's not the case. Now we know that institutionally, credit risk and credit registers are important elements that increase the safety of the system. Now we have those elements. Bankruptcy procedures, yes, unfortunately very different in each country, but by and large, at least in the Baltics, they are much more efficient than they used to be 15 years ago. So if your granddad told you, don't go to the forest because wolves are there, oh, come on, people, you know, it was a long time ago. Okay? Don't be scared too much of the past. Manage the risks of the future. That would be my take on this. Thank you.
No, that's a very important point. And that's the hard part, both for the banks and for us to look into the future and find scenario analysis of how this can be done. But just briefly on this discussion here, so precisely for the reason that has been mentioned that we all, you know, the past we come from is very different. So countries were hit harder than others by the global financial crisis. The economic situation is different. So this is exactly why we need the discussions around the supervisory board table in the full format, and not having, you know, discussions about, you know, smaller banking units or countries that move ahead. We need this discussion around the table where also different experience are brought to the table, and which I think in the end gives us better solutions to the problems we are facing, because we can really draw on the experience of the entire euro area. And actually, I think these big reforms that I mentioned, the crisis management framework, EDIS, this is really what we need in order to also strengthen the framework around common monetary policy in the end. So this is not our task. We have a separation principle. This is the task of the monetary policy side of the ECB. But in the end, this is where we are operating in an integrated financial system. So this is also why we need the same rules across the system. I think this is really, really key.
Okay, let me go back again to try to filter and you know, play back some of the questions here. So overall, I mean, it's a very lively discussion here also in terms of just the questions, so lots of interest. One example that comes up here quite often is the recent bid by UniCredit to acquire Commerzbank. I take it probably none of you would want to discuss the individual case, but you're just in conceptual terms. Is this what we need? More of these sort of cross-border mergers? Is this a way forward to, basically to complement the cross-border banking dimension? Maybe who wants to take it? Yeah.
Well, okay, as a host, most likely I have to take the unpleasant questions. but if my colleagues want to chip in, of course, as well. I will not comment on specific cases, and that is not allowed, and that would be very bad tone to give. But we need more cross-border view on the capital flows and on the banking flows and on flows of other financial market segments. So we need more pan-European and global perspective, by all means.
Well, I basically alluded to that issue already. Same here. I would never ever comment on individual cases in the public, of course. But we have a very clear guidance as we treat mergers, cross-border, domestic. We treat them according to the same standards. We all know that mergers can have beneficial effects in terms of economies of scale, scope, diversification. We also know they can lead to higher risks, and this is all clearly in our guidelines, in our rules, and we look at this very carefully.
A follow-up question related to that. The question is basically, how about foreign banks' behavior in host markets during periods of tension, crisis? So basically, I think that relates or plays back to that question. If you sort of follow, for instance, the German debate on that specific case that you would read in the press, fears that financing of SMEs might dry up in case there are issues in the host institution. Is there something that is well addressed in the regulatory environment we have here? Is this a fear that is justified, or is there something that needs to be added, or is this just something not founded at all? Basically, I think it relates to the question, if I have an entity that is essentially engaging in a cross-border merger, does the acquired entity is treated the same as the host? I mean, as the acquiring entity would be treated in terms of ring fencing of liquidity, ring fencing of capital.
Okay, I think you're doing a very good job to try to push the same question. But unfortunately, we will not give in on this. But what I would say is that I would see that if that market segment is profitable, we should not look at the way if one market participant does something else, that it would destroy the market. The market should be agile enough, and there would be new players coming into the market. Okay, so I think let me answer a different issue. Is that we need to reduce those transaction costs and transition costs so that if a single market player changes its strategy for whatever reason, okay, that there is somebody else who comes in and takes care of it. Okay? And this is in fact very similar to what we saw in the Baltics. And I'm not going to mention the banks, it themselves. But if you take a look at the loans, and it's not a link to the German case in any way at all, okay? So don't relate it to that. But what do we see in Latvia, Lithuania, in Estonia? The major difference currently is that in Latvia and Lithuania, loans to GDP, if we look at this segment of the market, are in the range of only about 30%, somewhat less in Latvia, somewhat more in Lithuania. In Estonia, it's above 60%. And if you take a look at 2008, at the peak of the boom, when the bust started, but with some small differences, but Latvia and Estonia had loans to GDP close to 100%. Loans to resident households and corporates at close to 100%. In Latvia, due to structural changes, we saw a gap in the market opening up, similar in Lithuania, and no market player came into the market. Okay. In Estonia, 2 local banks became more aggressive, and their deleveraging stopped at about 70% to GDP. So the bank competition in the financial market, bless you, is extremely important to be supported so that there is more competition within the market, that there are more agile market players, that they are more flexible, and they seize the business opportunity when it arrives. I think this is the fundamental thing that we need to look at. Competition will lead to a better outcome.
Okay, no, I think that makes a lot of sense, and I was just trying to play back what is here in the audience in terms of most asked questions.
Of course, your job is to ask questions.
Exactly, and of course, I mean, I think if you sort of we are close to be wrapping up, and I would like to end the panel with two similar or same questions to ask each of you, and with the sort of plea for a short answer, but maybe just to wrap up a little bit. So, I mean, I think in the end, it's clear that in some sense, more Europe is the answer. At least that's, if I sort of listen to all of you, is very likely the recipe. Also, in terms of the way the questions are framed here, I think a lot of the listeners, the audience, were sort of intrigued by the evidence offered in terms of the difference in lending rates. That should be ample grounds for academics to maybe also look into the issue and see what is actually here behind that fragmentation. But let me basically come to the questions. So, and maybe let's start with you, Gonzalo. What is the most important change from your perspective in the next 5 years in European financial markets? That would be my first question. And that's, of course, an open question. And then we have a more yes and no type of question. Will we have the Capital Markets Union completed by 2030, so in 5 years' time?
Okay, to the first question, Jens, there are many important changes that we can see in financial markets. But let me just propose one, the establishment of a lender of last resort formally in the Eurozone, as in the US or in the UK, because that will bring about benefits to the entire banking system. It might also unlock some of the problems that we are experiencing, blocking the progress in dossiers like CMDI. Maybe with that liquidity backstop, there could be more capacity to negotiate with the member states on CMDI, and it would also give time when it comes to resolution of medium-sized banks, what is also at the core of the discussions, because that would give, that liquidity backstop would give the time that is needed for a sale of business. That is the typical resolution strategy of medium-sized banks, and now there is no time at all because immediately the debt is written down and the bank enters into resolution, which is a different scenario. So I think it would bring a number of benefits if we see that in the next 5 years. And on the Capital Markets Union, will we see Capital Markets Union in 5 years? The answer is it will not be completed, but we have an opportunity to lay down the foundations for it to happen in the longer term. And at the end, with these very, very long-term projects, you need to know what is the final destination, and at the same time, you need some quick wins in the short term. For me, the quick win is to have securitization back in the market, because that will unblock a lot of capital of the banks that can be used for further lending, where the risk can be distributed to other investors, professional investors, that will allocate it according to the capacity of the economy to take up that risk. And then in the future, it will take a long time. Maybe, well, this has been discussed this morning, that there is a need of a change of mentality, as Governor Kazāks said in his keynote speech, and I cannot agree more. But a change of mentality might need a generation, or maybe two. You cannot tell people, put your savings at risk tomorrow in the markets if that is not the risk appetite of citizens. But I think a very instrumental change that could really be effective here and now is incentives to the investment in private pension plans. Because the Scandinavian countries, including Sweden and Denmark, they have this capacity to invest in more productive investments because they have private pension plans. So if other countries don't have them, a way to stimulate that would be fiscal incentives. I mean, less taxes. If the citizens put aside a certain amount of money, that will have a double advantage. First, that money could be used to finance productive investments until retirement, and then when it comes to retirement, citizens will be better equipped to face up that stage of life. So I think that could be a critical change that can be agreed in Europe now.
By the way, this is just exactly out what the current coalition in Germany, for instance, tries to channel more savings into equity investments on pension funds. Governor Kazāks, your take.
I fully agree on this. And you need to start somewhere. And there is need for quick wins. And some of those wins to shape and change the behavioral culture, may take really a long time. But some of the things are very much a matter of choice, a matter of nudge. And for instance, referring to the Latvian case, talking about the same pensions issue, securitization, to which I fully agree. Okay? People may choose to be in the wrong pension plan, according, for instance, by their life cycle perspective. If youngsters are not taking on the risk when they become part of the pension pillars, okay, the second pension pillar, which is individualized, okay, it's not pay as you go. First one is pay as you go. If you happen to be put in a pension plan that is very low risk, very low return at an early part of your life, then when you will retire, your pension plan is going to be of very low value because you have not used the risk price opportunities. So these kind of things are very much just an administrative decision. You just, by default, set the pension plans to the age of the person. Okay? And then, of course, there's always somebody who is smarter and knows how to move these things. They may have an opt-out, and then they may choose a different plan or something like that. But the default choice may well be according to the age of the person. And that is an administrative decision which just makes the basic decision on average correct. Okay? So these kind of things, I think, can happen very quickly. And in Latvia, we have a move towards that as well. But coming back to the things that we would need to do, and unfortunately, I must say that there is no silver bullet. Okay? There is no one thing or one button that we could push, and tomorrow is much better than it was today. And all the tools that we have at our disposal as central banks or supervisors are second or third best. Of course, they do improve the situation, and we will use those tools to improve the efficiency of financial markets and the benefit to the society in a way that banking system and financial markets are developed, they are profitable, they are safe, but they are also agile. Okay? And they are effective and contribute to the incomes and well-being of the population in a more long-term perspective rather than short-term profitability perspective. Profitability is very important, okay? Because otherwise banks would not be safe. We need profitable banks, but we also need banks that take on and manage risk, so the boats that go out in the sea. But unfortunately, my first best is very much still in the hands of policymakers, of politicians. And this is very much also to what Luis de Guindos referred to in the morning, incomplete architecture of euro area. Okay? It is, of course, fiscal as well and all these things, but on the part of financial markets, that would be a very nice thing to have banking union completed. It would be very nice to have capital markets union also completed. Unfortunately, if I may comment on these two things, it's politically very difficult. Everybody knows that banking union is very easy to do, but it's politically very contradictory. Okay? So this is really the case when you can push the button and you have the outcome. But politically, there is no agreement to push the button. About capital markets union, it's a no-brainer. Everybody knows that we need that. Okay? But the problem is that it is very complex. There is no one button. There are rows of small, various-sized buttons to be pushed in every and each country, and that makes the practical implementation very difficult. But these are the things that we need to do. Unfortunately, no silver bullet. But the important thing is that we know what needs to be done, and the external world is pushing us towards it. If we don't do it, then we feel it as less growth. If we feel it as less growth, then the people's incomes are not improving.
I take it as a no for the 2030 question on Capital Markets Union.
No, I think Capital Markets Union, to a large degree, if there is a willingness to do it, of course can happen. The only problem is that in Europe we have had massive jumps ahead when the crisis hits. So I hope that there is not going to be a very bad crisis in 5 years' time. So then most likely the process is going to be relatively gradual, okay, rather than big breakthrough.
Well, your question is in a way philosophical, so I'll be also on this philosophical mode. People tend to overestimate these short-term changes and underestimate long-term changes. And the past has huge inertia and persistence. We're still using cash, which came to Europe about 500 years ago. What I mean by this, when I think about, you asked a question about capital market union, we talked a lot, we talked about banking union, and definitely we have regulators here, and it's like you want to jump in this area of regulation saying that, okay, it's going to happen or not going to happen. But the thing that's really changing the financial landscape, and I'm a little bit afraid that regulation here is, when it comes, it might be too late, how the financial markets will be functioning after 5 years, is the computational power. It's doubling every 6 or 9 months. So we talk about artificial intelligence, and this is like the short term. I think with that computational power, exponential growth, for me it's hard to imagine how, and I know that distributed ledger technology is employed in various segments of the market, and in some cases this regulation may be overcome or not even needed, because I think that's the change, that's the factor, and I don't know, it's hard to imagine, but I think in 5 or a little bit more than 5 years, financial market may be somewhat different animal than we, maybe products are similar, but the engine inside the product might be different. What regards the capital market union completion, so it depends how do you define completed. That way we have this full access to finance the way the fathers of the idea want. I don't think so, but I think we could make a good progress toward it.
Just briefly, because we all look a little bit reddish now because it says time's up here on the screen, big time. So just very quick thoughts. Clearly, what needs to be done is in the hand of politicians. So for us, it's easy to say these things because we're not, for most of the things, we're not directly in charge. But I think what also needs to be borne in mind is that we see significant changes that are actually not under control of the politicians. So geopolitics, demographics, climate change. I mean, there's all political solutions to it, but this will also shape a lot how the financial sector will evolve and how growth will evolve. So I think it was said earlier, usually Europe has waited until the next crisis hit to kind of implement the things that were well known before. So also, you know, there was thinking about the banking union before the global financial crisis and the sovereign debt crisis. So I think this is now really the time to come together and decide to implement the policies that have been well drafted, thought through, and really push Europe forward, which is of course difficult because we're in an environment where not everybody's really convinced that we need European solutions. We are, I think, but I think this is not shared by everybody. And I think it's also important to go to the parts, and this has been said here before, which are politically more difficult. So the securitization, this one example, sometimes I worry a bit that this is also used because it's there are other, in the context of CMU, there are other files which are more difficult actually, and securitization, I don't think personally from a prudential perspective, we need changes in the regulation. We can see whether we can speed up the approval of securitized product for a given risk transfer. So all these things we can do, but I think the politically harder parts are elsewhere, and I think collectively we should also go there. Thank you.
So then, thank you very much. This concludes our panel. As Chair Buch was saying, there's a big red flashing up, time is up. So I think the time is up for the panel and the time is now for lunch. Thank you very much for your attention, and thank you very much for the panelists.
Thank you. Thank you, Jens, and thank you to the panel. Well, lunch is almost there, but not yet. So I must say, after this great panel, I have one more analogy to complete about the forest. So, you know, the wolves were there a long time ago, but there are also mushrooms in the forest. So if you're too afraid of the wolves, then you don't get to pick the mushrooms. But there is one man standing between you and the lunch still, and that's not me. That's the governor with his closing remarks. So please.
Thank you. Thank you very much. And I think we had a very good day. And thanks to all the panelists and my colleagues for sharing the thoughts and ideas. How do we move forward? And I'm not going to hold you for a long time, just a couple of points to take away. And point one, I would say 3 points, okay? Point one, in terms of the sailboat metaphor. We have boats, and we must sail. And I think that's the mindset that we need to have. We are prepared for the situations on the sea, but there is no point to have the boat that just stays in the harbor. And as we heard, then perhaps the barnacles take over, and at the end of the day, you know, there is no good use for that. So I'm not satisfied with banks just being safe and financial market just being safe. We need to be healthy in terms of the financial market. So there is competition that is beneficial, both in terms of risk-taking and also the services to the society and the clients of the financial institutions. Point two. My second point relates to the great philosopher Aristotle, and he wrote that, and let me quote something along these lines. Of course, he was not writing it in English, but he was saying that virtue is midway between insufficiency and excess. We have seen in the Latvian case the excess of early 2000s, and we see in many cases insufficiency of the current situation. So let's move towards the golden middle, okay? And that would be beneficial not only for Latvia, Lithuania, Baltics, but also for Europe overall. That's point two. Point three, and let me quickly quote here Mario Draghi, okay? He's been quite popular today because of his report. But one of the things that he at some point said is, if we in Europe want to preserve our sovereignty, some of it has to be shared, okay? So let's think European. Let's take the European perspective. This will open up lots of opportunities that we do not have when we think locally. If one wants to be big, one needs to think big, okay? And let's do it. So thank you very much. And before we close and have lunch, and keep chatting about these issues in the afternoon. I want to say a lot of thanks to the team at Latvijas Banka for making this event happen, and especially big thanks to our colleagues from SUERF. It's been a pleasure, and thank you very much for helping out. So, see you next year, and next year with lots of deliveries. Okay? We have the plans, let's bring them on. And next year, let's have some boasting competition of who has delivered more. Thank you.